Recording in progress.
Good morning, everyone. Welcome to IFRS 17 seminar. My name is Hassan Latiya. I am acting as the Vice President of the Actuarial Science Club in King Fahad University of Petroleum and Minerals. I'm working as an actuarial specialist. We would like also to thank SHMA team for participating in such events to increase the awareness of the actuarial profession in the region. SHMA is a well-known consulting company with a very excellent team serving many countries, including but not limited to the Saudi Arabia, UAE, Bahrain, Egypt, and many more. So without any delays, we shall start, I think, with Sayyid Shiraz Anwar.
Assalamu alaikum. This is good morning, everyone. This is Abdul Muid. So basically, I will be just giving the introduction here, and then basically Shiraz will start from the first session. So I will just take 10 to 15 minutes just to introduce what's the sort of today's agenda and what we are planning to do today. So basically, in the today's session, if there is any question, you can also write in the chat box, or maybe if you can also raise your hand, and we are happy to respond to any queries. Today's agenda is basically IFRS 17. IFRS 17 is a new accounting standard which will replace IFRS 4. And today's agenda, we will be starting to discuss basic actuarial understanding for the life insurance, and then in the second part we will be discussing the actuarial understanding for the P&C non-life insurance and health insurance. The third part of the today's agenda is to discuss the accounting part. Again, I'm assuming that the audience here is relatively student and entry level actuaries. So it is basically just to ensure that everyone have the basic understanding of the actuarial cash flows, life, non-life, and then basically we will move on to accounting part. I assume, by the way, that everyone can share my screen. If there is any sort of issue in terms of voice or in terms of sharing the screen, just please let me know, Hassan. And the next agenda is to discuss the overview of IFRS 17 requirement, and that will be sort of covering most of the IFRS 17 requirement applicable for life insurer, non-life insurer. And then after that, we will have a comparison of IFRS 17 and IFRS 4, just to give again what is there, what we have in IFRS 4, and how IFRS 4 items will be moved from IFRS 17. And then basically we will have a very short ending remarks after that. So moving on, the next slide is the introduction. Thank you, Hassan. By the way, you giving a broad, high-level sort of introduction of SHMA. SHMA is as a insurance and actuarial consulting firm. We operate in various countries in UAE, Pakistan, KSA, Lebanon, Egypt, Oman, and other Middle East countries. Our focus basically is to serve our client and then to train people like you to ensure that the insurance industry of KSA, UAE, and the other countries are working towards the updated requirement from the regulator, from the accounting bodies, and the international accounting practices, as well as actual practices. After that, we so basically, and then our firm again believe that this session will be very important session for all of you guys, especially you being like the entry level or the maybe student at various sort of stages, maybe first year, second year, or maybe final year. So we believe that this IFRS 17 standard webinar would be very helpful for you to understand what's the sort of new requirement, how we need to equip ourselves to in terms of the new requirement, and so on. So we encourage you to take interest in this webinar. And if there's any question, feel free, please to let us know. You can also write again in the chat box if there's any question. So just giving a very very small introduction about SHMAs. We provide services in for life insurance company, general insurance company. We also provide the retirement end of services benefit. We also provide services to family and general takaful companies in terms of enterprise risk management, capital modeling, and again the accounting services, including IFRS 9 and IFRS 17. So this is this is just the very high level introduction, what type of services we provide in terms of our services. After that, we have this in terms of where do we operate, is like we operate more than 8 countries in Middle East and South Asia region. We have a more than 20 years of experience in this industry. We have around 7 fully qualified actuary and 7 associate actuary. That's where we mentioned total 14 qualified actuaries. So I think in this region, finding like the total 14 qualified actuaries in one firm, plus various actuaries at various level, like mid-level actuaries, 3, 4, 5 exam, or maybe 1 exam, or maybe nearly qualified actuaries. So basically, our team is comprises of total 70 plus actuaries in an SHMA. And we have a couple of few accountants as well who actually work on like the accounting standard IFRS 17 and IFRS 9 implementation. Again, we have an experience of more than 40 years, not limited in KSA. We operate in KSA, Pakistan, Qatar, UAE, Lebanon, Bahrain, and so on, again, like including some South Asian countries, Sri Lanka, Egypt, Oman, etc. So basically, this is our, you can say, the practices is not again limited to Kingdom of Saudi Arab. So hopefully you will, after this webinar, you will be able to understand various sort of concept of IFRS 17 from our expertise. In the today's presentation, we will be myself. My name is Abdul Mueed. I'm the director here of the SHMA Consulting. And then we also have a like ending session given by Mohammad Saeed Zafar. He is also a managing director of SHMA Consulting. Rest of them are the speakers here. You can see Shiraz. He is also qualified actuary. Mohammad Osama Dangra. He is also a fully qualified actuary. He's a senior manager. And then basically we have Asad Villani. He's an associate actuary. He's working with us for more than 8 years experience. Then we have Kurtal and Hamid. She is again working with us. She is an associate. Sarah, again nearly qualified actuary. And then basically we have also Muzammil. He is working with us, and he is again an associate. And for Sarah. So this is the basically broad, you can say, high level introduction of today's presenter, including which include like all of them are like associate and fellow in terms of the actuaries qualification. So moving on, next is basically what is IFRS 17. IFRS 17 is mainly applicable to insurance company. So basically it touches, it replaced the existing IFRS 4 accounting standard. And it contains various areas which, and it resolved various issues as well, which was the limitation of IFRS 4. So this include like consistency, transparency, uniform reporting standard, etc. IFRS 17 is applicable from, and SHMA has also adopted the applicability date from 1st January 2023. So basically we don't have as such enough time. So insurance companies here in this market are working very aggressively, and SHMA has also issued various sort of stages to implement IFRS 17. So again, this is the again purpose just to brief what insurance industry are doing in terms of IFRS 17 implementation. And this is again, you guys are very important just to understand the basic concept. And eventually I hope inshallah that you guys will be working and in various sort of with the insurer in KSA, and that will, this session will sort of be helpful for you to understand IFRS 17 basic concept and to apply in future in your practical life. And again, IFRS 17 scope is, as I mentioned, is limited, is applicable to insurance contract, reinsurance contract, and investment contract. So basically, insurance contract is exactly. I hope that you guys are familiar with the insurance contract. Mean that these are all insurance companies which are operating in KSA market. So they sell insurance policies which include motor, medical, PNC contract, life insurance contracts. So these all contract requires the revision of the accounting standard for IFRS 17. And again, this is not just limited to again the insurance company. Is just like we need to understand what exactly is IFRS 17. So hopefully in our today's session, going forward, our speaker will explain you the basic actuarial and then basically the IFRS 17, and what we as actuaries we can do in terms of implementation to implement IFRS 17. So this is it from my side. If there's any question, I'm happy to take on. Otherwise, Shiraz will continue from going forward from the next session.
Right. Thank you. Thank you. I'll just take over from here unless anyone is willing to ask a question. I'll share my screen from my end. Thank you.
Thank you. Thank you. So again, you can write in a drop the chat box if there is any question. We are happy to respond. Thank you.
Yeah. So if there are no questions, I'll just begin. Yeah. I'm assuming there are none. All right. So, all right, guys. So I'm Shiraz. I'll be taking you through some of the basic actuarial understanding related to life insurance valuations, right? So, as part of this presentation, I won't be touching about the specifics of IFRS 17 relating to life insurance valuations. Instead, I'll be taking you through some of the current considerations that are not exactly IFRS 17 specifics, but obviously related to valuations of life insurance liabilities. Right. So as a very first step, as a very first starter thing, what you need to understand is that if you are going to do the valuation of life insurance products, you need to understand the type of insurance products that there are. Right. So life insurance products works on the so valuations basically work on the concept that you have to essentially project cash flows under each and every insurance contract. Right. So each and every insurance contract has completely separate and completely different dynamics. Right. So I'll just take you through a few. So these are a few sample insurance, some of the most common ones that you basically see in the market. So on the very left hand side, you have the term insurance. Right, so term insurance is a very basic product. So term insurance basically covers only death or disability benefits, right? So only upon an event in which the insured person basically dies, or if he sort of incurs if he incurs a disability, only then a payment from the contract it will incur. Right, there are no survival benefits. So if you are being covered for let's say 5 years, and you survive that entire 5 years without anything, right, so you are benefiting from nothing. Right, so well, it's a good thing if you survive actually, but yeah, from a financial perspective, you are actually losing money on insurance. Right. Typical terms of these term insurance products tend to be between 5 to 20 years. So, life insurance tends to be very long term, right? It can go all the way until the whole of life, right? And investment risks under term insurance, they basically tend to be very minimal, right? So these products tend to be designed for protection purposes only. Surrender benefits are little to none in this case. Now, on a very contrast, you have the endowment products. So endowment products are, they basically work in the same way as a term insurance does, but at the same time, you also have a survival benefit available to you. So if you survive the entire term of your coverage, you will basically be getting you'll be basically getting your whatever your coverage amount or your sum insured is, right? So you have a fixed sum insured. It can be 1 million, it can be 10 million, right? And you'll receive it either if you die or if you survive the entire term. So you're going to receive it anyway. obviously it will be charged more than as compared to basically if we compare the term insurance plan, right? Investment risks, as you can imagine, they are really high here. So you're basically promising the policyholder that you will in fact reimburse them the entire sum insured in the event that they survive it. So there's a big payment waiting at the very end of the contract, right? And then there is the surrender benefit. Obviously, if halfway through the contract you basically decide that you want to discontinue the contract, you are basically entitled to you're basically entitled to a surrender benefit. Basic surrender benefits like it's like present value, it's like a value of the contract at a specific point in time, and you can basically surrender your contract, and you can sort of nullify the contract and take whatever the residual value is. Now comes the time of now we basically move to universal life contracts. So universal life contracts and as well as unit link contracts, they are basically they are sort of evolution in terms of how life insurance products are basically structured. Now, in both the term and in the endowment products, there's one thing in common. You basically pay a premium, right? And you get the coverage, right? It's as simple as that. But in universal life and unit link products, what the new thing was that it brings in the concept of account value, right? I'll explain to you it's basically being dead, in a subsequent slide. I will deal it over there as well, right? So what UL and as well as unit link products do, they basically sort of create an account value. So in this case, when you pay a premium, the company deducts a series of charges, a series of service charges, right? And only those service charges are basically the sort of revenue that relate to that basically relate to the insurance company, right? And the rest of the premium, it all goes into your account value. It gets invested in your account value. So essentially, when you pay a premium, it goes in two buckets as opposed to going in only one, right? So investment risks, if I talk about universal life, the investment risks tend to be moderate here, and they can be very high, they can be very low. So the idea in universal life is that I'm basically operating a sort of an insurance fund, and I'm at the same time I'm sort of operating a complete investment fund, which is the account value of the policyholder. Now, what I do, how I do things here is that I invest the investment fund of the policyholder in a separate account, in a separate investment fund, and then on a periodic basis, I sort of I allocate a certain amount of profit to basically their account value. So uh, it's not exactly a direct linkage, as far as how should I say that, it's not exactly a direct linkage it's not a direct linkage considering the investment fund itself, right? So the investment fund is being dealt with separately, right? And how you credit it, it may or may not mimic exactly the same performance as a complete investment fund, right? So surrender benefit in the universal life case, they basically tend to be account value. Now, in contrast, if you look at the unit link fund, what unit link fund does, it's like a mutual fund. Now, if you have heard of a mutual fund, what mutual fund does is that you basically buy a share in a complete fund. Now, as part of this fund, there's a problem here. The fund can basically go up, the fund can basically go down as well. Now, it's not the case in terms of universal life, but it is the case in case of unit link policies, right? So unit link policies, they can go down, right? And all of the investment risk is basically being borne on the part of the policyholder. So none of the investment risk is basically part on part of the insurance company. The insurance company is only investing on your behalf, and it will be entitled to a certain charge of the investment service that it basically provides, but it's not participating in any of the investment risk as part of unit link products. But in basically, if I look at universal life, there is a certain downside risk that basically the insurance company will have to bear, right? Now on the fifth one, these are the riders. These are basically small attachments to basically they are small attachments to the main policy, right? You have the term insurance riders. Term insurance riders basically indemnify you with upon that you will get additional you sort of get additional sum assured. A family income benefit is supposed to be an annuity. So if the person dies, the family will sort of receive a sort of a annual benefit, if you may, right? It will be like 15 or 20 years, and it will continue for the complete term, right? And then you have the accidental death and disability benefit. So if the death is sort of accidental, you will get additional sum insured. And in the event of critical illness, if you sort of come up with some of the covered illnesses. By covered illnesses, they basically tend to be cancer, or it can be heart diseases. In that event, you may also receive additional sum insured as well. So, and the very fifth category, and the very fifth category, you have the refund and the waiver of premium riders, right? So in that case, you will basically be receiving all your premiums back in certain specified events. So in case it could be disability. So if you get disabled, or if the insured person dies, all the premiums will sort of get waived. All the future premiums will sort of they will get waived, and the policy will sort of continue for basically the policyholders, beneficiaries, right? So if a person is sort of covering, is buying a policy for any of their loved ones, they will have the coverage is still flowing, the investment value will still continue to accumulate, even if the policyholder sort of dies, or gets disabled, right? So I'll just move on to the next slide. Right. So in this very slide, I'm sort of it sort of illustrates the mechanics. It sort of illustrates it's a sort of a bucket rule, I would say, right? So conventional products, the products like endowment, or even term insurance, they basically get all of the revenue and all of the expenses. They basically get dealt under one single fund, right? All of your it's a single fund. All your premiums get pooled into that fund. The fund basically earns investment income. You pay out the claims, and then you pay out the expenses, and then whatever left, it's the remaining fund value. So it's a whole concept of insurance, right? The concept of insurance is to basically diversify risk, right? Is to accumulate a large amount of people, and all those people, they basically pay a certain amount of premium, and we know for a fact that only a certain amount of those people, a certain number of those people, will actually incur a claim, right? So it's how the pooling of risk works, right? Now in account value products, when we talk about unit linked, or we talk about universal life products, right? A two fund rule goes, right? And it can be more than two, you never know. In the case of the takaful, it's actually three. So an account value, what happens is that so you have a sort of an insurance fund, and then you have investment fund. Now there can be many investment funds. It's up to the discretion of the policyholder. He may or may not, they may choose to invest in more than one, right? It's completely at their discretion, but they have to pay a premium. And from that premium, they have, a certain amount of service and risk charges. They basically get deducted. And these charges right over here, right? Right. So all these charges right over here, they are basically the revenue of the policy, of basically the insurance company. Now on this fund, obviously the insurance company earns a bit of investment income, and they pay the claims and the expenses. So you can understand that if the company is basically charging for service and risk charges, it has the responsibility to pay any amount of insurance claims, as well as expenses, right? So it's how the insurance fund works. And if we move forward and we look at the investment fund, right? So the way that investment fund works is that so all the remaining portion of the premium. So after deducting all the charges, right, the service charge and the risk charge, the remaining portion of the premium gets invested as part of this investment fund. You basically accrue the investment income. You pay out any kind of reimbursements on account of account value. So if I'm withdrawing my account value, it's relates to that payment. The withdrawal of account values can be on many occasions. I may voluntarily withdraw it, or it can be in the event of a claim, right? So if a person dies, he is entitled to all of his accumulated investments. And after that, the company also sort of deducts a fund management charge, a sort of investment management charge. And this management charge basically goes and becomes part of this, right? And it goes and becomes part of the main insurance fund. So it's revenue for, it's revenue for the insurance company as well. So you can see that, if I look at the very first one, at the very first fund, the very first fund is basically the ownership of the insurance company, and the very second fund is basically the ownership of the policyholder himself, right? So we have segregated those roles, right, as opposed to the very first one. Okay. So moving on. So there are certain considerations when you're going to do life insurance valuations, right? So the concept of life insurance valuations is that you have to project you have to project cash flows under those contracts, right? And then you obviously to project those cash flows, you have to basically incorporate a certain level of assumptions about the timing and the amount of the cash flows, right? And how do you build that in? Right, it's the key here. So the very first thing that you need to consider is what are the insurance risks and what are their associated assumptions. So in the case of life insurance, obviously the very obvious risk is basically it's the risk of death, right? Or it can be the risk of disability, right? And it can be many other things. So if you're including, if you're including critical illnesses or other sort of eventualities as well, it will incorporate all those risks, right? And then you have the cash flow timing. So every insurance product, so the way life insurance valuation works is that you have to look at every single insurance product and consider all all the timings, all its benefit patterns, everything that you have to take into consideration before you go into projecting the cash flows, right? The other aspect are the expense assumptions. Obviously, as you're servicing the contract, right, you will incur a certain amount of expenses which are related to basically servicing that contract, right? So these are also to be part of the part of the cash flows as well. And then you have the surrender options. So surrender options can have that ability to sort of to sort of change the amount as well as the timing of the cash flows, right? So if I have a 10-year policy and I'm projecting a 10-year cash flow, but what at the same time I'm giving us a sort of an option to the policyholder to sort of surrender it, he may surrender it at any time point, as part of the 10-year period, right? So we have to take it into consideration if that thing has has sort of a material substance, if that scenario has a sort of commercial substance, it has to be incorporated as part of the valuations as well. Now comes the part of the discount rate. So discount rates are meant for you to calculate it's meant to calculate the present value of the cash flow. So valuations are supposed to be at a single point in time, right? So as part of valuations, what you do is you project future cash flows and then you discount them back to a single point in time. That is the value of the contract, basically. Right, and then you have the maturity / account value. So maturity values are a very important assumption. Obviously, maturity. Is there a variable maturity benefit, or is there a floating maturity benefit? It's something that is of immense consideration, right? So if it's a fixed one, it's less complicated. If it's a moving one, it can get really complicated. And then the very last element of it, the embedded options and guarantees. Embedded options and guarantees create a lot of complications as far as life insurance valuations go, right? So if you're promising a policyholder that upon maturity that you will reimburse, that there will be a minimum amount of maturity benefit available for them, it's something that has to be valued for separately, right? And it's part of the valuation process as well. Now I'm just showing a sort of a snapshot of a very important element of life insurance valuations, right? It's a mortality table, right? So mortality table are basically the key ingredient basically as it comes to life insurance valuation. So what a life insurance, what a mortality table is mortality table sort of gives you a probability of death at it gives you a probability of death at basically every age, right? So if you can just look here, if you just look at the if you are just looking at on the very left hand side, you have a mortality rate of age 45, right, of 2.77, right, and then you can see it's basically increasing. On the fourth column, you have the rates of females, right, and you'll notice that female rates are actually lower as compared to male rates, right. And the third and the fifth columns are basically the life expectation at that age. So a person age 45 has a further life expectation of 32 years as part of this commissioner's life table. So what I'm showing to you right now is the commissioner's 2001 standard ordinary mortality table. It's a very famous one, in the it's a very famous one in it's being used in US. It's a very famous one in US, right? It's often used as part of statutory evaluations, right? So it's just to basically show you exactly how mortality tables work, right? So moving on, and so it's very important to sort of highlight the valuation principles and challenges. So what exactly is basically the concept behind actual valuations. So at this point, this very statement, as which has been adapted from basically IFRS 17, it's highly important that what exactly the valuations mean is that you have to sort of calculate a probability weighted mean of all possible scenarios. So if you have, so compare it with basically throwing a die. A die has a total of 6 scenarios, right, and all of them are basically equal. But in an insurance contract, there are a variety of scenarios. And as you add on and as you pile on more and more benefits and more and more, more and more complications on part of the product itself, it becomes really and highly, becomes really and highly complicated as well. So the major challenges that you see as part of of life insurance valuations is that how do you come about the probability distribution for each and every scenario, for each and every risk as well, right? So a contract can sort of incorporate mortality risk, but it can also incorporate a lot of investment risk as well. So if you're basically throwing in a sort of embedded option as part of the contract, it will create a lot of complications, right? Then there is the aspect of changing trends. So life insurance contracts, they basically tend to be extremely long-term contracts, right? So as part of those, so if you're valuing a contract which has a time horizon of 20 or 30 years, a lot can happen in those 20 or 30 years. Mortality trends can actually improve. Cat claims can occur. Aliens might attack you. You actually never know, right? But it's a trend, capturing those trends, and it's very much linked to exactly what your time horizon of your projections are. It's very much linked to that. So it's a big challenge, I would say, in itself. Then you have the extreme events. How do you measure the extreme events? So the concept of valuation says that you need to capture the full range of possible scenarios for basic for you know for your reserve to actually have true substance, right? So you have to have all scenarios captured. So all scenarios actually mean extreme events as well. Extreme events can have extreme events can have a lot of results. So they may cause a lot of correlations on part of many risks, right? And a single earthquake can basically cause a lot of claims simultaneously, right? It's how it gets complicated. Then you have the interaction between risks. So there might be a certain amount of mortality. There might be a correlation between this. So if we talk about surrender or we talk about mortality risk, there tends to be an element of correlation on part of surrender as well as mortality risks as well. So it's often the case that a lot of good risks, that they basically tend to surrender earlier, and as a result of it, in your insurance pool, only the bad risks remain, and as a result of it, the mortality risk, it will go up, right? So good risk basically they basically leave the pool, and what remains are only the bad risks. So so basically surrender and mortality, they have a very good level of correlation, right? And such kind of correlations, they basically exist on at many levels, right? Now I'll just give you a background of the sort of valuation methods that are basically being followed at this moment, in the complete industry. So at the very outset of it, on the very first part of it, are the very basic methods. They are basically the unearned premium reserve methods. So what is an unearned premium reserve method? So if I'm being insured for a total of 1 year, right, and I'm valuing my contract at the mid of the year. So I'll just say that the contract has been issued for let's say 1st January until 31st December. So it's a 1 year contract, and I'm sitting at basically 30th June. So a total of 6 months has sort of elapsed, right? And I've charged the policyholder a total of let's say a million rupees in premium, right? So that means that after 6 months, half the duration has sort of elapsed and only half remains. So what I'll do, instead of projecting the cash flows forward, I'll just book 50% of the remaining premium, right? It's as easy as that, right? So I just took 50% of the remaining premium, as only half of the coverage period has sort of elapsed, right? So it's a very basic and a sort of a very primitive method in itself, right? After that came the basic net premium valuation method. So again, it's a very old method in itself. So what happened here was that as part of this method, only the actuary is only supposed to sort of project in its cash flows all the mortality as well as the morbidity benefits, as well as so basically all the insurance benefits, right? It won't include any of the expenses. It won't include any of the investment components. Basically nothing, right? It can only include, as part of projections, only the mortality and the morbidity as well as the maturity components, right? And obviously for that purpose, the premiums, so basically the concept of projecting cash flows and the life insurance valuations, that you have to project future benefits that you're going to pay, as well as the future inflows that you are going to receive, right? So premiums being inflows. So for this particular method, what we do is that we sort of adjust things, right? We don't do the we basically adjust we basically sort of calculate we calculate a net premium. A net premium is sort of a risk premium only, right? It basically exclude all of the life, or it sort of excludes all of the expense as well as the profit related loadings, right? So when you basically charge for risk, you not only cover the amount of risk that you are providing, but all the expenses, there has to be a margin in the premiums for all the expenses that you're basically going to incur, right? As well as a tiny bit of a profit margin as well, because well, obviously it's what you're here for, right? So after that, a certain level of evolution happened, and then there came the gross premium valuation methods, right? Now, as part of the gross premium valuation methods, now at this point in time, you have to sort of project everything that is basically related to basically the insurance contract itself. You have to project the insurance benefits. You have to project the servicing expenses. You have to project all of the surrender scenarios, as well as and the premium inflows will be based on whatever the actual premium is, right? So the very first three methods that I've illustrated, these are what are called deterministic methods, right? There's nothing stochastic about it, right? They are all based on a single set of best estimate scenarios, right? Now, And then you have the very fourth method, and it's based on it's entirely based on completely stochastic methods, right? So as part so stochastic methods, they basically tend to become necessary as the complications regarding to your contract, they basically grow, right? So if there are certain components as part of your contract that basically create a lot of variability as in basically the cash flows of the contract, right? At that point in time, you have to basically resort to stochastic methods at that point. And it's something that I will demonstrate as part of an example as well further. All right, so now I just take you through a simplified endowment insurance example. So, like I told you earlier, an endowment insurance is a contract in which you pay a certain premium, and for that you will receive a certain amount of benefit if you die or if you survive the entire term of the contract, right? So in this particular example, if you look on the very left hand side, the premium that you're being charged for is 200,000, and the coverage amount is a total of 1 million, right? The age of the policyholder is basically 45. The term is 5 years, and there are no. We are basically, for simplicity's sake, we're not assuming any kind of surrenders. Mortality rates are based on the Commission's 2001 mortality rates, so it's basically the same mortality table I showed you earlier. And then there are commission expenses. So commission expenses are basically, they are expenses that a company incurs on sort of acquiring the contract, and they have to pay it to basically whoever the selling agent is, right? So if it's being sold to a company's agent, he will receive the premium. He will basically receive the commission, right? And then you have the admin expenses. The admin expenses are 200 per policy on an annual basis, and then you have the discount rate of 2.5%. And then I'll just take you through the calculations, right? So again, like I said, the very essence of life insurance valuations is to basically project the cash flows, right? You have to project the cash flows, and for the cash flows, you have to follow a sort of a expected cash flow basis, right? So expected for when I say expected cash flow, it's supposed to mean the probability weighted average, right? So in this case, the only probability that is sort of affecting us here is the mortality rate. Over here, as you can see, it's the QX over here. So what the QX denotes, the QX is basically a probability of death at a certain age within the very next year, right? So if I look at 0.00277 right over here, it's basically the age of death for a policy holder who has basically who basically at the start of the year he was basically 45 years old, and at the end has basically and basically over the next 1 year, the probability of his death is basically 0.00277. And so it goes. As you can see that that basically the probability of death, it basically increases with age, obviously. Right. So and then on the very fourth column right here, you have the PX. The PX is a sort of a survival rate, right? So if you do not die in any given year, you basically survive. So until 0.1, the chances of survival are 0.99723, and the chances of death are 0.00277, right? So if you add these both of these numbers, they will basically add up to 1. As probabilities naturally do, they all add up to 1. Now, if you come to time point 2, in order for a person to die in time point 2, the person will have to survive. Time point 1, and then he will have to die in time point 2, right? And in the very fourth column, 0.99421 is basically the probability of surviving year 2 as well, right? It's basically how it goes. It's very simplified mathematics. So expected death benefit. So the expected death benefit is basically is a multiplication of the probability to basically the sum insured of the policy. right? So the sum insured under the policy is a total of 1 million, and that multiplied with, if you look at the mortality rate over here, QX, basically gives you 2770 over here, right? And that is how you basically project the cash flow. So, and as you will see that in the very last tab, and in basically time point number 5, it's I've also included what is basically it's a maturity benefit as well. Right? So if a person basically survives all the way until time point 5, the person will be receiving the complete 1 million the complete 1 million benefit. But obviously that has been multiplied to basically the survival rate of 0.98399, right? So it has been probability weighted, that to put it simply, right? Now we have the expected expenses in the second last column right over here, right? At point 0, you basically incur the admin expenses as well as the commission. If you can remember, 30% was the commission on the premium, on the first year premium, being 200,000. So 60,000 worth of commission has been incurred, as well as a cost of 200 as well, right? Since this amount has been incurred at point 0, right? It's complete. It's the probability. If I apply the survival rate at point 0 is basically 1, right? So at point 0, since you're buying a policy, it means that you are alive, right? So obviously, as a result of it, the actual the probability weighted amount is exactly the same as basically the actual amount, right? And the same is the case when you look at the premiums as well, right? So just put it there that all the death benefits and all the maturity benefits, they have been assumed to sort of incur at the end of the year, and all the expenses and all the premium incomes have been assumed to sort of incur at the beginning of the year, right? So all of these cash flows have been probability weighted accordingly, right? So in the case of premiums, right, you have to sort of survive the entire year to basically pay the premium. So 200,000, it will come anyway, because the person is buying the policy, he will have to pay the premium. But the next premium, the very next premium of the second year, he will only pay if he survives the 1 year. So in that case, you basically multiply 200,000 to basically the PX over here of 0.99723, right? So it's how it goes, right? And then as part of the valuation process, what you simply need to do is you need to take the present value of all these cash flows, of the debt benefit, of the benefits, of the expenses, of the premium income, right? So if you can look over here, right, the present values of each of these cash flows have been calculated, and the discount rate is basically illustrated in the very second table on the second column. 1.9756, 1.9518, 1.9286, 0.90595, and so on, right? So you have calculated the expected death benefits, and then you have discounted it right over here, right? And then the simple method is to basically sum all these columns together, right? If I'm going to calculate the present value as a time point 0, which is basically calculating to a negative number, and I'll tell you why exactly is that the case, right? So in this very situation, the present value of the premiums, if you take the present value, if you take the sum of the present value of the premiums, right? The basic formula being that the basic reserve formula is that that it has to be a sum of the present value of outflows minus the present value of the minus the sum of the present value of basically all the inflows, right? So in this case, the only inflow are the premiums, and the death benefits, the maturity benefits, as well as the expenses are basically your inflows. They're basically your outflows, right? So as part of this, you basically sum all these together: present value of outflows minus present value of inflows, right? And they all at point 0. At point 0, you will be summing up all of the cash flows, right? And they all sum up to minus 1347. And this now the reason that this number is basically coming up a negative number is because in this case the present value of inflows is actually larger. is actually larger than basically the present value of basically all the outflows, right? And which is a natural case, right? If I'm providing services, right? I'm providing the death benefit services, I'm providing expenses, and I'm charging a premium for it, right? So essentially, all of these things, the present value of my inflows, it should come up higher, right? If the present value of inflows comes higher than my present value of outflows, only in that case I will be making a profit, and it's a very necessary condition, if you are to make a profit, right? After that, if you look at the reserve column and you look at the reserve, if you look at the trailing reserves, right? So at point one is the reserve of all the future cash flows, assuming that you have survived until point one, right? So if you have survived until point one, the remaining period of the coverage, it's only 4 years, right? And you're entitled to basically all of the coverage as part of any death benefit as part of those 4 years, as well as the maturity benefit, right? And you have to pay a total of 4 premiums that are basically remaining, right? So at that point in time, if you value the present value of the death benefits and the expenses, and you minus the present value of the premiums, it will come out to a total of 139531, and so forth, right? So it's what is the very basic principle of actuarial valuations in a conventional or as part of an endowment insurance contract perspective. Now I will throw in a unit-linked insurance example, right? So a unit-linked insurance is a bit of a complicated thing, right? So as I told you earlier, the unit-linked insurance product, it sort of utilizes a two-bucket principle, right? So you have two funds now. You have an insurance fund, which is basically the ownership of the insurance company, and then you have an investment fund, which is basically the ownership of the policyholder himself, right? So obviously, both of those funds are being managed by the insurance company itself, but the ownership varies, right? Now, as part of this contract, I have sort of tweaked the example a little bit, right? Now, as compared to the previous case in which a 200,000 annual premium was being paid. In this case, a single premium of total of 1 million, it will be paid, right? Sum insured will be exactly 1.5 times the single premium. It will be 1.5 million. As a result of it, age is still 45, term is still 5. Mortality rates. So like I told you before, as unit-linked products go, the revenue of the insurance company is not the premium, it's now the charges that it collects, right? So as part of this, these products, the company has to divide the premiums into a set of different charges and a sort of a deposit component, right? So as part of these products, the companies tend to charge a lot of charges, right? They basically divide the whole thing in a series of charges, right? So in this case, mortality charges are being charged according to the Commission's 2001 mortality rate, right? So in this case, the benefit in this particular product, the benefit will not only be the sum insured, but it will also be the account value. So if a person dies, right? If a person dies within the term of the contract, which is basically 5 years, the person will basically be receiving a total of 1.5 million as part of the death benefit, and he will also be receiving the complete account value that has basically accumulated on his behalf on the investment fund as well, right? Now, obviously, all of these now at this point, since the investment fund is basically a totally separate component, but since how should I say that? Since basically the insurance company is sort of covering the mortality risk, and it's providing the benefit in the case of demise, in this case it's 1.5 million. It's going to sort of deduct, it's going to sort of charge for that service, right? So as part of that service, it will be charging a series of mortality charges on a completely annual basis. Right. Under this policy, commission of 7.5% of the premium is being paid, right? To basically the agent again. Admin expenses are still the same. They are being incurred at 200 per policy per year. Allocation charges of 10% of premium, they will be incurred, right? And then you have admin charges of 250 per no, of 250 per policy per year, right? So as you can see, the company is sort of incurring an expense of 200, but it's charging for its expenses at a rate of 250 per policy year. So again, it's making profit on that end. Same goes for the allocation charge. The allocation charge is meant to cover the commission expense, but as you can see, it's the company is charging 2.5% excess, right? So so again, it's making a profit on that end as well. And then the company is also charging a fund management charge. Like I told you, there's a separate investment fund, right? So since the insurance company is completely managing the investment fund on its own, it will sort of charge a certain percentage of the fund value on an annual basis, right? So it's in this case, it's basically 1.5% per annum, right? On basically whatever the fund value is. So if it's 1 million, it's going to be 1.5% of 1 million, right? And then we look at the investment fund assumption. So the investment fund is sort of running at 13.5% per annum. We have assumed that it has been invested in a sort of an equity fund, right? Which is basically based on the PS600, which is a Pakistan Stock Exchange, right? And then the insurance fund is basically which is the one being managed on behalf of the also on the end of the insurance company, right? Insurance fund is the one that is the ownership of the insurance company, and it's incurring a slightly lower rate. The reason for it being that insurance fund is not a freely moving vehicle, right? It's supposed to manage expenses. It's supposed to manage all the insurance payments. So as a result of it, the investment policy under this fund, it cannot be very aggressive. So if you're not willing to go aggressive, you will only earn a very menial amount of investment return. But on the investment fund side, it's ownership of the policyholder. All the investment risk has been borne on the end of the policyholder. So if the policyholder bears all the risk, then you can basically go all in. And it's obviously on the choice of the policyholder. So let's just assume in this case that the policyholder has opted for a completely 100% equity fund, right? So when we talk about reserving on the end of unit-linked insurance policy, so these are account value policies, basically. At this point in time, under the IFRS 4 regime, right? I'm not touching upon the IFRS 17 regime as of yet. Yet, what basically companies do and what we are supposed to do is that we have to divide the complete reserves in a total of three segments, right? First of all is the account value itself. Right, so whatever the account value that each policy holder has sort of accumulated, it's a reserve in its own, right? So you can basically book all of the account value as a single reserve, right? Then and again, as you can notice, there is no cash flow projection involved here. So whatever is the account value balance, it will come off as it will come as a total reserve. Then you have the non-unitary reserve, right? So the non-unitary reserve is the fact that if I'm the insurance company and I have taken charges to basically cater to expenses as well as mortality benefits, so I have to sort of keep a reserve for those. Like if I have taken charges and I've yet to provide those services, right? I'll have to retain a certain amount of those charges in case, in case claims, they basically, in case claims sort of incurred, they get incurred in the future, right? And then there are the value of embedded options. Now, if you have an embedded option, if you're giving a sort of an embedded guarantee, right? If you're sort of giving an investment guarantee, like for example, if you're saying that in any case, the insurance company will make sure that basically that basically the policyholder, they basically receive all of their account value they basically receive all of their original investment, right? Regardless of the fund regardless of the fund performance, then it sort of incorporates and it forms a sort of an embedded option. It gives you a sort of an implied guarantee, right? So if I'm investing 1 million and the company is guaranteeing that no matter what, if even if the stock market tanks, will still give you a total of 1 million back, at least, at the very least. And if it goes up, you will still get you'll basically get the higher number, right? So in that case, it's sort of a put option, right? So all of these three elements as part of the unit-linked insurance reserve, they basically make the entirety of the unit-linked policy reserve. So I'll just take the example further, right? So based on all the assumptions that I basically showed you, right? If you look at so at this very point in time, I'm not projecting the cash flows as I was doing in the as part of the earlier example. And at this point, I'm only projecting the fund balances of the investment fund as well as the insurance fund, right? So the investment fund, what's happening is a premium of 1 billion is coming in, and an allocation charge of 100,000 is basically being deducted. You have the mortality charges being deducted at various time points. As you can see, they're basically increasing. They're basically increasing by age as the mortality risk is also increasing. In the fifth column, you have the admin charges of 250. They're being sort of deducted. And then you have the investment fund after deducting all of these charges at the beginning of the year. So it's basically being assumed that all of the charges are basically being deducted at the very outset of the year, right? At the very outset of the policy year. After that, investment income gets accrued, and then you sort of deduct the investment management charge at the very end of the year, right? So the investment management charge is basically 1.5% of the fund balance at that point in time. The fund balance at that point in time would basically be the beginning of the year balance as well as the investment income accrued throughout the year, right? So investment management charge is being deducted at the very end of the year, and then you have the investment fund after deducting the investment management charges as well as crediting the investment income. And then what happens is that you basically roll forward all of your investment fund, right? So in the very next year, again the same cycle repeats. You have the opening fund of 100,15253, out of which the risk charges have been deducted, admin charges are being deducted, and you are again left with an opening investment fund balance of 996,458. Then again 134 a total of 134,522 of investment income is basically accrued on this beginning of your fund, upon which again you will basically be deducting the investment management charge all over again. So it's an entire cycle, it's an entire repetitive cycle, and it will sort of grow the entire investment fund all through the 5 years, right? So at the very end of the 5 year, as you can see, a total of 1.5 an amount of over 1.5 million it has been accumulated. So all of this is basically based on on a certain set of deterministic assumptions. So again, at this point in time, no, you can see basically there are no stochastic components as such, right? Now, how exactly will I reserve? How will I do the actual reserving as far as this product is concerned, right? The very first element of my reserves will actually be the investment fund value. As you can see, I have labeled it in red, right? So if I'm doing the reserving at the very end of every year, right, my all of my account value, all of my account value related reserves will actually be based on the value of the investment fund itself. right? So no, so basically no any kind of cash flow predictions are not involved here, right? Now we'll just take a small look on the end of the insurance fund, see exactly what is happening over there. So we can see uh, on the part of the insurance fund, all of the expenses that were incurred on the end of the investment fund are basically the revenues on the part of the insurance fund, right? So as you can see, 100,000 that of the allocation charge that was basically deducted as part of the investment fund, it is now a revenue under the under the insurance fund. Same goes for admin charges, right? They're basically coming here. This charge is coming here, right? And now we are assuming that that basically the policy has not incurred a claim. It has survived towards the end of the 5th year, right? No claims are basically made on this policy, right? So as a result of it, the no claims have been paid, right? And only the company has basically incurred a set of expenses which are relating to commissions as well as the admin related expenses based on the same set of assumptions that basically I showcased earlier, right? Now, again, it's the same mechanics. Insurance fund, after adding in all the inflows and subtracting all the outflows, you have an opening insurance fund balance on which the investment income is accrued and the ending insurance fund is sort of determined. So at this point in time, the ending insurance fund is basically the ownership of the insurance company. All of these amounts are basically the ownership of the insurance company, right? So now, the, if the insurance company wants to keep a reserve, now I'm talking about the non-unitary reserves, the reserves that are not related to the account value. What exactly should those reserves be? Well, the company is sort of providing, the company is charging, right? The company is charging for basically insurance service, and is charging risk charges for that purpose, is charging all its expense charges. So if there is an unearned portion of risk charge, right? So if at any point in time, right? If you have, for example, in this very particular example, yeah, all of your risk charges, they are basically being deducted at the very outset of every year, right? So each charge is basically meant to cover any all of the insurance claims as part of that year, right? So it's how diversification works. So you basically collect a lot of risk. You basically collect no, a series of risk charges on from basically a lot of a complete pool of risks, a complete pool of people, right? And then you basically sort of diversify all of those risks in the sense that you know for a fact that if you are covering a total of 100 or 1,000 people, only a certain percentage, we can say 2 or 3% of those people will actually be incurring a claim, right? So you have to be, so you have to charge just enough. So in order to procure enough revenue from all those 100 or 1,000 people, so that it can meet the all the claim expenses that are emanating from 2 or 3% of the pool of the total pool of those people, right? So you have to charge only that amount of money, only that enough amount of money. It can be higher, but if it's lower, that only then you will basically run into a sort of a solvency risk, right? So on the end of the risk charge, right? Uh, the only amount of reserve that is basically relevant on the end of the insurance fund is going to be any unearned amount of risk charge, if it remains, right? In this very case, all of the risk charges are being deducted at the very outset of the contract. And since I'm doing the valuation at the very end of the contract, at the end of the policy year, at the end of each policy year, all of the all of the risk charge that I've basically received, it has completely been earned, right? So I won't be booking any kind of risk charge reserve at this point in time. So again, at this point, I'm assuming that there are no investment guarantees as part of this product, right? I'll just throw in a case where I made such a guarantee, right? So at this point, I made a guarantee that basically the policyholder, if the policyholder is sort of investing a total of 1 million, right? He will basically be receiving at least 1 million at the end of the contract, right? how do now how do I value this embedded option, right? Now the very I would say the only solution is basically to do simulations, right? And mind you, it's not a very easy task. Like if you're going to fit a model, if you're going to fit an sort of a probability model, a simulation model on basically market movement, on investment return movements, it's going to be extremely tricky. You have to cater in the fact uh, what is the exact asset mix of the current investment fund, right? It can be based on equities, it can be based on bonds, it can be based on the mix of those two, right? You basically never know, right? And the more the complexities, the more the complexities in the product, in the options, the more complex your job becomes, in order as on the part of making models, on the part of doing the cash flows, and part of doing the projections. So I'm just illustrating, a simplified case, a very simplified put option, right? In which case that the policyholder has sort of invested in the Pakistan Stock Exchange Fund, right? And he is at least entitled to basically the return of his original investment, right? In which case, in this case, it's a total of 1 million. So if he's investing 1 million, he's entitled to receive at least 1 million at the end of 5 years. It can be higher, but it cannot be lower, right? So as part of this simulation, what I'm illustrating is, I'm not going to go in the very minute details of the model itself, right? But I'll just throw in a little bit of a background. It's basically a regime switching log normal model, right? What a regime switching log normal model is, a regime switching log normal model is basically a collection of two log normal models, right? So you have one log normal model, you have one log normal model sort of representing a very stable investment return period, and you have another log normal model that is basically representing a rather unstable period, right? So if you can just look at the parameters as well, mu1 and mu2. So mu1 is sort of a positive amount, and mu2 is a negative amount. So mu2 is sort of reflecting a very adverse scenario, and how should I say, sort of an adverse investment period, if you can say that, right? And you can also notice that if you look at the sigma parameter of mu1, it's actually lower as compared to sigma parameter of 2, of log normal model 2, right? So basically, as part of this, log normal model 1 is basically representing a high return period, or also encompassing a very low volatile period. But log normal model 2 is sort of illustrating a very negative return period, at the same time also showcasing a sort of a very high degree of volatility as well. So if you can look at the sigma parameter, it shows a high degree of volatility as well. Right, P12 and P21 are basically transition probabilities, from basically one state to another, right? So mu1, so if you're transitioning from state 1 to state 2, which is basically represented by each of the log normal models, it sort of represents the transition probability between them. So as part of this, we have carried out a total of 100 scenarios. In real life, they tend to be much higher than this, right? The parameters of the regime switching log normal model, they have been calibrated over a 20-year return period. They were calibrated on a 20-year return period. And then 100 simulations were basically carried out, basically projecting the complete 5-year horizon period, right? Now, as part of this 5-year horizon period, what we saw that in a total of 30% of the 100 simulations, only 30% of the scenarios were basically resulting in an account value, only 30% of the scenarios were basically resulting in an account value which was actually lower as compared to the original investment, right? And if we take the probability weighted mean of all the scenarios, right? So in all the scenarios, if I'm at this point in time, I'm only determining the value of the put option, right? So all the scenarios that result in basically a higher account value, the impact on the put option will be nil, right? So if the account value actually exceeds the original investment, right, the actual impact on the put option, it will be nil, right? The put option will actually be useless, but it will only materialize in the situation where basically account value actually drops, right? So on that basis, incorporating both the probability of each scenario as well as the commercial impact. The commercial impact of the scenario which in this case is that if it falls below the original investment, how far does it fall? Right. So on that basis, if we take the probability weighted average of the whole put option, it calculates to 8.89% of the original invested value. So it's just an illustration. It's meant to show you how to exactly value, if you have any if you have any kind of embedded options, and sort of creates a need for more complex, for basically more complex solutions, for more complex models as well. Now, what do you need to expect as part of IFRS 17? So, as part of if we look at life insurance valuations throughout the years, people have been doing a lot of different things, a lot of they have been following a lot of different guidelines. There have been a lot of how should I say, a lot of variations. If you look at market to market, a lot of people actually do valuations on a purely account value basis. They basically tend to keep things simple, right? And even if there are any embedded options, they basically tend to completely ignore them, right? But at the same time, there are people who are actually doing the valuations, who are actually doing the simulations, and they are actually valuing they're valuing each and every of the options. What IFRS 17 is asking you to do is to do cash flow modeling, in basically all the cases, right? Even if it's an account value product, even if it's a conventional endowment term insurance product, you have to do the cash flow simulations, and you have to capture all the scenarios, right? All the scenarios basically need to be captured, and for that purpose, you need to develop more and more expertise, and it's basically it's a big challenge on the part of, it's a big challenge for even the most seasoned actuaries, right? And as part of this, you have to really think through all the risk factors of all the probability distributions. You have to bring all of that information together, all the interaction between risks together, and therefore what is being expected of you is that you capture a complete range of all scenarios. All your cash flow generations, they have to be much more detailed. They have to capture all of the related cash flows that are basically part of the insurance contract, whether they be expenses, whether or they can be surrender benefits. You have to capture all of those things together, right? So it's a big challenge, and it varies from product to product, right? So it's all from my end, right? For basically today, I'll be happy to take any questions if you have them coming, and right, and after that I'll hand it over to basically the next speaker. So over to you guys. Hi. Are there any questions? You can basically just type them in the chat box, and I'll be happy to basically respond to those. So anyone from the Actuarial Club side, if you guys have any questions, before I basically hand over to the next speaker. Oh, all right. Something I see, some sort of chat. What is the software that is used for making simulations? Well, it can be. It doesn't necessarily have to be software, right? It all depends on the actuary's ability. A lot of a lot of companies basically tend to buy. all of the a lot of companies basically tend to buy they basically tend to buy softwares from basically vendors, right? There are a lot of vendors available, the likes of Towers, Watson, and even IBM. They have a lot of models, right? And if you're really interested into looking into economic scenario generators, I suggest that you also look up SOA as well. Right. So I suggest you can also look it up on basically SOA as well, right? And they have a complete economic scenario generator. They have a complete paper on it. Well, it's not a paper; it's a complete book on it, I would say, right? And they have a model on it on there as well. So yeah, some people they basically tend to sort of generate their own models. Others they basically tend to, they basically tend to basically use they basically tend to use software services that are provided from external vendors as well. So it all depends from case to case. The level of complexity that you're dealing with, it all depends on you. If there are any more questions, I'll hand it over to. All right, so right, I'll just hand it over to basically the next speaker, which is basically Asad Belani. Right, Asad, if you're there, you're ready to, you're basically okay to take over, please.
Thank you for your formative presentation. There is also one question, if you can answer it in the chat.
Oh, sure, I can do that. Can you again go through log normal model once again? I just got connected. I think it will take a lot of time. If you guys want me to do it, I can do it, but I will leave a little less time. But also we'll basically be providing you all the copies of the PPT. So if you want, you can basically, you can look it up at a separate time, or you can reach out to us as well, right? So I just don't want to hold up the next speaker. That is. So if it's okay.
Yeah. Also, this presentation is recorded and will be uploaded on YouTube, so you can see it again, unless you have a specific question in this model.
All right. Okay. I think it's all from my end now. Asad Bilani will basically take over. Thank you, guys. Thank you, everyone.
Thank you again, Shiraz, for your informative presentation. This was a very helpful and a beautiful presentation. The next presenter is, I think, Asad.
Yes, that's me. I'm here. Thank you so much. Should I share my screen?
Yes, please share your screen. Yeah.
Let me know once it is visible. I've shared my screen.
Yeah, you are visible now. We can see your screen.
All right.
You can start.
Just start. Let me know once. Okay, so I should start, right? Right. Thank you so much for being part of this this seminar. My bit basically pertains to the non-life insurance implications, and I will try to give you a very quick and a basic background of what are the actuarial methodologies which are involved in valuations for non-life insurance. And this will be under the IFRS 4 regime, the regime which is currently in place. And then later in the seminar, we will be discussing on how these can be translated into IFRS 17 regime. So this is the agenda, the topics that we will be covering. We will start with what is insurance, the very basic form of insurance. I'll take you to the very basics. And then the dynamics which are there in issuing an insurance contract. This is from the perspective of an insurance company. And then we'll talk a bit about what is actually the need for an actuarial valuation. and the type of liabilities which are calculated in an actuarial valuation process, and the methodologies which are used. In the interest of time, we'll try to do this as soon as possible, and I will try to keep it short. And but I'll be happy to take any questions as they come. All right. So, what is insurance basically? In its very core basis, insurance is a contract. It is a contract between an insurance company and an insured, where the insured pays an amount to the insurance company, which is called the premium. And in case of a contingent event, now this we'll talk about this contingent event, but if an underlying contingent event occurs, then the insurance company compensates to the insured. It provides a financial compensation due to the loss that the insured would incur because of the contingent event. If the contingent event does not occur, there is no payment made, and the premium essentially becomes part of the profit for the insurance company. So, in its very basic, this is how the insurance contract would work. Now, what are contingent events? Contingent events are basically such events, the timing or the occurrence of such, or if a timing or the occurrence of an event is uncertain, it would become a contingent event. Under life insurance, contingent event is basically the death of a person. We would not know when a particular person or the insured would die. It is certain that a person will die at some point in time, but when that would actually occur is the point of contingency. So the contingency actually becomes the timing of the event in life insurance. In non-life insurance, the contingent event is everything else. Every other event can be considered. So every event which is not related to the death of a person would essentially qualify within a potential contingent event for non-life insurance. Now, anything other than death is kind of uncertain. The event may occur or may not occur, and therefore there is a wide horizon of probability for the contingent event to either occur or not occur in under a non-life insurance contract. The probability could be on the higher side as close as to 1, and it could be on the lower side as close as to 0. Certain events in which the probability is closer to 0, we call them low frequency events. And for events where the probability of the contingent event to occur is on the higher side, we call them high frequency events. So this is basically the events that would be a contingent event under which a life insurance contract would trigger a payment to the insured. Now let's talk about a few of the events that would be covered. These actually are not really events, but type of insurances or the insurance products which are offered in the Saudi Arabian market. Actually, they are quite common in the entire Middle Eastern market. These the type of products which you can see on your screen are products where insurance company would provide coverage or a payment to the insured if the insured purchases one of these products. So, for example, under the medical insurance, the payment would be made if the insured incurs an event in which he or she has to go to a hospital and get some medical treatment. Motor insurance would cover events of accidents. Travel insurance, for example, would cover any cancellations of travels, or it would sometimes also cover any health-related issues when a particular insured is traveling. Aviation insurance would be generally taken by the airline industries, where it will cover for any unexpected deterioration of their aircrafts. Marine insurance would cover, usually it is for, it includes marine cargo and marine hull insurances. It is for sea voyages. property insurance would cover any deterioration to the properties. It would also have fire and other perils such as earthquake, etc. A liability would be usually a common example would be professional indemnity taken by professionals such as doctors, for example, and would cover for medical malpractice. And general accident would cover is actually a very wide horizon. Examples would include bankers, blanket, and things like that. So these are the events, if they occur, would trigger a payment to the insured. Now, if we can just quickly talk about how what are the dynamics of an insurance contract, and how the insurance company would actually go on to determine the premium that it needs to charge to the policyholders or the insured. No, so what the insurance company would do is that use certain techniques and methods to assess the risk which is associated to the underlying contract, and it would determine the expected claim cost. This in itself is a very detailed and a thorough exercise, and perhaps calls for a different seminar altogether. But in its essence, an insurance company would determine the risk premium, which is the expected claim cost. Then the insurance company needs to, of course, administer the policy. It needs to issue the policy. There are costs associated to such services, and also there are costs associated to the administration of claim if it occurs. That is, there are certain costs which are directly associated to the claims, which are called allocated claim administration expenses, and then there are certain costs which are unallocated. So, for example, the insurance company would need to have a claim department itself, or a call center which could attend to any calls that are made by the insured. This would essentially become the expenses for the insurance company, and would be loaded to the risk premium, which determined in the first step. This risk premium then is combined with the expenses, and then of course there are certain taxes that the insurance company has to pay. There are always taxes and commissions as well. So sometimes for an insurance contract, generally for large corporate products, there could be an agent involved and could result in commissions. So the insurance company would charge these as well as part of their expected cost to be paid out. All of these, the risk premium, the expenses, and the other loadings combined would eventually become the gross premium. This is the premium that the insurance company would charge to the insured. Sometimes the insurance company may want to get into a reinsurance contract. A reinsurance contract is a contract basically between an insurance company and another insurance company, which insures the first primary insurance company. The second insurer would be called a reinsurer. In its very basic form, there are two types of reinsurances. There's proportional reinsurance and there's non-proportional reinsurance. Proportional insurance, for example, be a quota share contract in which certain percentage of the actual insurance contract is ceded to the reinsurer by the insurance company. So, for example, a quota share contract could be 50%, could result in a 50% sharing of the contract, which would mean that the insurance company would pass 50% of the premiums to the reinsurer, and if and when a claim comes, 50% of the claims would also be passed to the reinsurer. So it's a proportional reinsurance contract. A non-proportional reinsurance contract would be where the claim in excess of a certain amount is actually passed to the reinsurer. These are called excess of loss reinsurance in this region. They are also called stop loss reinsurance, and there are multiple names for such arrangements. But what would happen in this contract is that the insurer would only pass claims which are in excess of a predefined amount to the reinsurer. And the reinsurer, based on this arrangement, would actually charge certain amount, which is not proportional, a fixed amount to provide these services. The reinsurance basically allows the insurance company to take on more risk, and therefore, given the risk appetite of the company and the capital in place, they may not be able to issue or undertake certain large risks, due to which the insurance company would actually go on and reinsure certain particular risks. Moving on. Okay, so when we talk about insurance contracts, there are certain considerations that needs to be understood, and these are again from the perspective of an insurance company. What an insurance company would do, that it would issue insurance contracts throughout the year. Generally, non-life insurance contracts are for a period of 1 year. They could be for longer periods as well. But majority of the non-life insurance contracts issued in this region, in the Middle Eastern region, are for a period of 1 year. These contracts are issued throughout the year. They would be issued on perhaps every day of the month, every working day of the month, and throughout the year. The timing of different cash flows within an insurance contract is such that the insured pays the premium to the insurance company in the onset. That's at the start of the contract, which we call the inception date. On the other hand, the claims are paid by the insurance company to the insured when they are reported, and sometimes even after certain other processes. So there is a lag between when the insurance company receives the premium and when it actually is required to pay the claim. And therefore, there is a timing issue about which we will discuss a little later. Then an insurance company, like any other company, would need to carry out financial assessments. They need to know what has been the performance throughout the year and what is its current financial position. A process which is usually carried out at the end of each quarter, sometimes, and necessarily at the end of each year. Now, at the time of carrying out this financial assessment, there would be multiple insurance contracts which are issued by the insurance company, and each of this contract would be at a different stage in its entire cycle or its life. There could be contract which would be issued only a couple of months ago compared to a contract which would be issued close to 10, 11, 12 months ago. And therefore, all of these may result in different types of liabilities or different amounts of liabilities for the insurance company. We should understand that the insurance contract essentially results in a liability for an insurance company, a potential liability, and this could be there could be a huge range of the potential liability that the insurance company would have due to an insurance contract that it. This means that this triggers a need for an actuarial valuation at the time of the financial evaluation of the company. The actuarial valuation essentially means that the insurance company would need to carry out or determine what is the amount of liability that it may require to pay off at any given point in time. So it is an as of amount as of the valuation date. The insurance company would like to make an assessment of the potential liability which it would need to pay to its insureds. Now there are certain types of liabilities, 3 different types of liabilities which are determined during an actuarial valuation. These can be categorized into premium-related liabilities, claim-related liabilities, and there are certain expenses which also needs to be accounted for. The premium-related liabilities would be unearned premium reserve. So this means basically that at the valuation date, and I believe Shiraz also touched about this in his presentation, what would happen is that at the valuation date, all of the premium which the insurance company receives may not be earned by the insurance company. For example, if the valuation date for an insurance company is 31st December, that's the end of the year, and it has issued a contract on 1st of July for, let's say, 1,000 reals, uh, at the valuation date, which is 6 months after the issuance of contract, half of the contract period would have passed, and half of the contract period would still be unearned for the insurance company, and therefore it would require to reserve for half amount of the premium. So if the premium is 1,000 real, 500 real would be earned by the company as of the valuation date, which is 31st December, and half of the premium, 500 reals, would not be earned and becomes an unearned liability for the company. The premium deficiency reserve, it is one of the more complex types of reserves. This would mean that after the issuance of contract, if the insurance company believes, or if there are facts and circumstances which would indicate that the premium that the company has charged for the insurance contract is not sufficient, it would need to put in some amount from its own profit. The insurance company would need to fund this amount from its own pockets or its own profits, and in order to meet the potential liability, an additional liability that could be triggered due to charging lower premium than it was required. So if, for example, a payout from an insurance contract is 1,200 reals and premium was charged at 1,000 real, the insurance company would need to fund an amount of 200 additional reals, and this would become a premium deficiency. Then there are claim-related reserves or claim-related actuarial liabilities. These would be outstanding claim reserve. These are perhaps the most simplest form of reserves, which means that the claims which, as of the valuation date, are already reported to the company. The company is aware of these claims and the potential amount that it needs to pay out, but haven't actually paid this amount yet. These becomes the outstanding claim reserves. Then comes the IBNR, and we'll talk about this in a bit more detail. But what it essentially means that as of the valuation date, there are certain claims which are already incurred. So the contingent event which we talked about has already happened, but the insurance company is not aware of it at the moment. These claims are not reported to the insurance company, and therefore these claims need to be reserved for as well. Then there are expenses. There are allocated loss adjustment expenses and there are unallocated loss adjustment expenses. So in order for the insurance company to administer a claim, it may sometimes need to incur certain other expenses. For example, a very good example would be motor insurance, where if there is an accident, there needs to be a survey carried out in order to determine the party at fault. And this is an example of an allocated loss adjustment expense, because the surveyor would charge a fees to the insurance company in order to provide his services. It becomes a allocated loss adjustment expense for which the company also needs to reserve. Then there are unallocated loss adjustment expenses. This would mean those expenses which cannot be directly allocated to a particular claim. Setting up of a claim department itself, or as I mentioned, setting up of a call center to attend to queries of the insured would be an example of unallocated loss adjustment expenses. We'll quickly talk about certain methodologies which can be used to determine all these type of actuarial liabilities or reserves. The first one is the unearned premium reserve. There are multiple methods to determine unearned premium reserves. Generally, I think the most common type is the straight line method, in which it is assumed that the risk is uniform throughout the period of the contract, and therefore the UPR, or the unearned premium reserve, is determined as a proportion of the time which has elapsed as of the valuation date. So in our example that we talked about in the UPR, it was assumed that it is a uniform contract, which means a straight line distribution method was used, and therefore 50% of the premium was earned and 50% was unearned. Then there could be other examples, other methods of assessing UPR as well. For example, in Saudi Arabia, the regulator has instructed that for marine line of business, for policies which are open cover, which are under the open cover marine line of business, for these policies, the premium which is written in the last 3 months essentially becomes the UPR. So certain portion of the premium is parked or is determined to be the UPR. It could be certain other portion as well. It could be a straight 25%, or it could be any other proportion which could be determined due to any existing study, or it could be instructed by the regulator. There would be non-linear method as well. Again, in Saudi Arabia, the regulator has prescribed a method for engineering line of business in which the risk is assumed to increase over the period of time. It is not constant throughout the period, and it is assumed to increase towards the end of the contract. So the risk is the least at the start of the contract, and it linearly increases towards the end of the contract. And therefore, there is a prescribed formula for such calculations. Then there are premium deficiency reserve. This is a very complex, certain complex cash flow projections are required to be carried out. We can talk about this in probably some other time, but this requires the insurance company to project all the cash flows that are expected in the future from the insurance contracts that it has already written. The projections sometimes or actually always requires a number of assumptions which are used to make these projections. And based on these, it is determined if the company needs to hold on a reserve for premium deficiency, that is, if it has charged lower premium than it was required to. Then there are claim-related liabilities, outstanding claim reserve. This is perhaps the easiest and the most simplest type of reserve because it is already known to the insurance company. Generally, the information is available through the administration systems of the insurance company where these claims are recorded. Then there are IBNR. IBNR are incurred but not reported. That's generally most demanding or most of the time for a non-life valuation actually would be spent in estimation of IBNRs. There are multiple methods. There are rule of thumbs, which is the most simplistic method. For example, previous regulations a few years back, again in Saudi Arabia, was that the minimum reserve for any non-motor property and casualty line was required to be held at least 15% of the outstanding claims. So the IBNR was determined as 15% or could be determined as 15% of the outstanding claim reserves. So that was the rule of thumb. These are usually used when there is not enough claim data to carry out more detailed analysis. Then there is triangulation method. These are traditional methods used by the actuaries in which the claim lag over a particular period is assessed. The actuary would determine how long it takes for a claim to eventually get completed, which means that after a certain point in time, it is expected that there will be no more claims which would be incurred but not reported, and therefore there will be no IBNR. So the triangulation method allows you to assess at the valuation date what is the amount which is currently in the IBNR, that is how much further the claim is expected to develop. And then depending on the line of business or the product or the events under consideration, there could be other non-traditional method as well. These could be determined on a case-to-case basis. Depends on the data and the capacity of the insurance company to carry out and devise these methods. We'll talk about a bit on the triangulation analysis. There are multiple types of triangulation analysis. These are done sometimes on the paid basis and sometimes on the incurred basis, which would mean that only claims which are paid are considered within the paid types of triangles, and within the incurred, the claims which are outstanding and already reported with the company are also considered to determine the lag. Then the triangulations can be constructed on accident period basis, which means that all the accidents which were incurred in a particular month, quarter, or year are grouped together, irrespective of when the underlying policy was issued. This could be one type of triangles. The other could be on underwriting basis. So, for example, all policies issued in year one are clubbed together, and the claims arising from all policies issued in year one are clubbed together, and year two are clubbed together, and then it is seen how long does it take for all the claims to be reported. Triangulations can be done on on different frequencies, on annual basis, on quarterly, and on monthly basis. And there are different assessment methodologies. So there's the famous chain ladder method, in which only the lag is used, which means how much time does it has taken on average for all the claims to get reported is considered. In BF method, Bonhoeffer-Ferguson method, we would see how much we will not only see how much time it has taken for the claims to get completed, but we will also bring into consideration certain other external knowledge that we have regarding any claims, and would reflect or make an adjustment for that. But the expected loss ratio is more of a judgmental method, in which if there is any information available where the actuary is able to assess what could be the expected loss ratio for a given period, be it an accident period or an underwriting period, that is used to assess what the ultimate claims could be. Ultimate claims meaning the claims which are already paid, claims which are outstanding, and claims which are part of the incurred, which are part of the IBNR. So these are the methods of triangulations which are used. And lastly, I think we have the expense reserves. Expense reserves are allocated loss adjustment expenses. We call them ALAE, and then there are unallocated loss adjustment expenses called ULAE. ALAE are usually can be allocated to a particular claim amount, and therefore are processed or accounted for or reserved for, I should say, with the claim itself. For the unallocated loss adjustment expenses, generally there need to be expense studies which are required to be carried out separately, and as a result of these expense studies, the actuary would know what portion or what adjustment is required based on the outstanding claims for IBNR, and what could be the potential loss adjustment, unallocated loss adjustment expenses. So I think these are the type of expenses and the estimation methodologies, which I believe covers, yes, it covers all we wanted to as part of this this webinar. I think I will be open to questions, and please let me know if there are any questions.
Yes, so there is 2 questions in the chat.
Okay, I will try to take a look. All right. How can we know? So the first question is, how can we know that we need a PDR? So for an insurance company to know if it needs a PDR or not, what it needs to do at each valuation date is project the cash flows for any given portfolio. And if the projected cash flows, that is the outflows, if it is more than the premium which the company has actually charged, then it means that the company is in need of a PDR. there are different ways to assess it. So for example, if the combined ratio, which is the claim ratio and the expense ratio together, is more than 100%, which means that the outflow is greater than the inflow, or I should say the projected outflow is greater than the inflow, then the company is in need of a PDR. So I hope that answers the question, Hassan. Then we have another question from Yusra. Why we did not include half yearly in previous slide for frequency? I am not sure I understand that question correctly, Yusra. You're asking why did we not include half yearly in previous slide for frequency? Would you please elaborate on that question? Meanwhile, I'll go on to the next question, which asks what is the difference between accident and underwriting triangles. So in accident triangles, what would be done is all the accidents which are incurred during any period are clubbed together, irrespective of when the underlying policy was issued. On the underwriting triangles, on the other hand, all the claims which are triggered from policies which are issued in a particular period are clubbed together. So if I'll give you an example, if the company issues policies in year 1 and year 2 and year 3, and if it is doing a valuation at the end of year 3, in underwriting triangles, what it will do, it will combine all claims which were incurred due to policies issued in year 1 on one side, and then on from policies which were issued in the year 2, and then from policies issued in year 3, and analyze them accordingly. In the accident year triangles, what it would do, it will see when did the accident actually happen, and then therefore club all the accidents which happened in year 1, club all the accidents which happened in year 2, and the accidents that happened in year 3. So I hope that answers the question. Then we have another question, which is what is the difference between the accounting method and the actuarial method? I'm not sure if I understand the question correctly. The accounting method and the actuarial method for determination of what? So Nora, if you can elaborate on that, please. And meanwhile, I have Yusra asked me to go to slide 15. All right, Yusra, I hope you can see my screen. I am at slide 15. Oh, here the frequency does not include semi. It can very well include semi-annual. So I have also seen companies doing it on pretty different frequencies. They've done it on fortnight basis as well. So it could be at any other frequency. These were just a few examples. It could very well be at semi-annual frequency. All right, I think I will just wait for Nora to elaborate a bit on her question if there is anything. I'm not sure. Should I wait for Nora? I'm a bit cognizant of the time. Hassan, should we wait for Nora or?
I think that's all the questions. Maybe there is other questions you are guys welcome to ask in the chat, and maybe we will answer it later.
Sure,
for the sake of time, we can continue with our next presenter.
All right, all right. I think it is over to you, Osama.
Sorry, I was speaking, but I was on mute. Thank you, Asad. Thank you, Hassan. Hassan, I'm sharing my screen. Can you just confirm if you guys can see it?
Yes, so Sama, your screen is visible and your voice is so clear. You can start.
Yes, thank you. So, good afternoon, everyone. This session is on accounting. In the first two sessions, Asad and Shiraz discussed some basic concepts, basic actuarial concepts for life and non-life business. Which might come in handy when we actually dive into IFRS 17. And in this session, we are going to discuss some of the basics for accounting, which might be required to understand the coming sessions on IFRS 17. In this session, we are going to start by an introduction of the financial statements and the accounting standards. Uh, next we'll introduce the current accounting standard, which is IFRS 4, and discuss some of the key aspects of it. And then next we'll move into the chart of accounts and trial balance. And here again, we will stick to a basic introduction and will not deep dive into these aspects. And we'll close this session by discussing some of the limitations and the problems of IFRS 4. I just want to point out that this session has been designed just to give an introduction and set some context for the main IFRS 17 sessions that are the two last sessions for today. This is not intended to give you each and every bit of detail of the accounting practices today and the challenges it presents. It's just an introduction. And before we dive into the session, I'd just like to conduct two small polls just to understand the type of audience that we have today. So, firstly, I'd like to know if how many of you guys are currently a university student, and you guys can respond by using the yes and no options on the participants tab. Uh, So do you guys see the yes and no options on the when you go on the participants tab? You'll see two options for yes and no. You guys can respond using those options. So far, we only have two responses which say they are not students.
I think maybe if you can't see any hand raised, maybe because the raising hand is disabled.
Yeah, but I said, do you? Some people have the yes and no option. I can see some responses. So four people have said no. One has said yes. I'll give it a minute for people to respond. Some people have raised hand. I have few responses, just a few responses in the chat and just a few responses on the participant tab. I'll give it some more time for people to respond, and then I think we can move on with the presentation. Okay, so we have got only a few responses, and from that I can see we have about, from people that have responded, I think 15 people. Most of them are not currently university students, and only a few are currently university students. So the next question that I have for everyone, this is for everyone again, uh, and that is, if you guys have studied any basic or introductory accounting courses. I'll give it a minute for people to respond, and then we can continue. So we have two responses for this. So far, we have got about 20 or some responses, and just 3 people have not studied any basic or introductory accounting course. Most of the responses that we have gotten have studied a basic accounting course. Okay, so I think we can continue with the presentation. So what we know, although we got a very, given that we have about 50 participants, we got very few responses, but what we know is that many people are not currently university students, and many people have done some basic accounting courses. So some of the content that we have in this session, especially for those people who have done some basic accounting courses or have completed their university and have started working or have done some internships, might find uh, a bit basic, but we because we have some people in the audience who are students or who might not have completed the completed basic accounting courses, so we'll start the session from a very basic or from a very introductory level, right? So the first thing we are going to look at is financial statements. Now, as I said, for those who have already completed accounting courses, this might be very basic and elementary. But for those who haven't, financial statements are basically written records that convey the business activities and the financial performance of a company. So it's something that you'll hear a lot when you get into the accounting business, actuarial profession. Get into this profession, you keep on hearing the word financial statements. And it basically refers to a set of records and statements that are used to communicate the financial performance of the company. In these, we have 5 types of statements. First is the statement of financial position, or the balance sheet. This statement is meant to show what assets, liabilities, and equity a company has at a particular point in time. So at the end of a financial period, what is the financial position of the company, what it has, what it owns, and what is uh, it has borrowed or owns to others. The second statement is the statement of financial performance, or more commonly known as the income statement or the profit and loss statement or the profit and loss account. This statement is basically a periodic statement which shows what income was generated, what revenues were generated, or what expenses were incurred during a particular period of time, which in most cases is either quarterly periods or annual periods. So this statement shows how much revenue came in, how much expenses went out, and what was the profit and loss the company made during the period. Third statement, and a relatively less famous one, or less common. It's still required by every company, but it's something that's not usually used by actuaries as much. Is the statement of changes in equity. It simply shows that the equity, which reflects what belongs to the shareholders of the company, uh, uh, and what are the changes during the period to the equity. This again is a periodic statement. So the first statement, the balance sheet, is as at position. It shows the situation as at a particular point in time, whereas the income statement and the statement of changes in equity is a periodic statement. The fourth statement, statement of cash flows, is also a periodic statement, which simply shows what cash was generated and how the cash was consumed. It basically shows a reconciliation between the change in the cash and the net profit for the company, profit and loss for the company. Finally, there are always notes or disclosures to these four statements. These notes and disclosures are meant to provide additional information to the users of financial statements regarding the four main statements that I've mentioned about these. So these will include all sorts of additional information that are unnecessary either by regulations or necessary in a management's view to explain the financial position of the company. Okay. Now, we know that every company is required to produce financial statements, but they cannot do it on their own methodologies and assumptions. They have to follow accounting standards. All companies have to produce accounts in a consistent manner. Not every company cannot do it on its own or methodologies. And and which accounting standards are applicable in a particular environment is actually decided by the regulatory body of the country. So, for example, in Saudi Arabia, the regulatory body for insurance companies is the Saudi Central Bank, or SAMA. The name has recently changed, and this is the entity which is responsible for deciding that what accounting standards will be followed by insurance companies operating in the kingdom. So what they have decided, the central bank has decided that in the kingdom, all insurance companies must prepare their accounts or financial statements using the international financial reporting standards. These are international standards which are produced internationally and are accepted in, I think, more than 100 countries. So IFRS is it has produced multiple standards for multiple business activities. So for insurance activities, insurance and reinsurance activities, the current standard is IFRS 4, which is being replaced by IFRS 17 in 2 years or less than 2 years time. And since SAMA requires that all insurance companies in KSA must follow IFRS, all insurance companies will have to move to IFRS 17 in less than 2 years time. It's also important to note here that IFRS 4 and 17 are just related to insurance and reinsurance transactions. So this does not mean that an insurance company will only be using IFRS 4 and 17. There might be some transactions, even if it's a pure insurance company, that fall outside IFRS 4 or IFRS 17. For instance, most of the transactions are related to invested assets. When a company purchases property, or when a company invests in say sukuks, right? Those type of transactions are actually not insurance and reinsurance, although they are being done by insurance and reinsurance companies. Because the transactions are not insurance and reinsurance related, those transactions are outside the scope of IFRS 4 and 17. So for those type of transactions, the company will have to decide what is the most relevant IFRS and apply the most relevant IFRS in that situation. In this session, we'll keep ourselves limited to IFRS 4, as I said earlier. And now let's take a quick look at some of the key aspects of IFRS 4. So the first thing when we're producing financial statements is the revenue. We need to know what is the definition of revenue. Currently, IFRS 4 basically is, as we'll see in the coming slides, it has many open areas, and it does not provide a precise definition or a comprehensive definition. So, what the general practice for by the insurance companies is today is that the revenue is defined as the unearned premiums for short-term business, which basically means that it is adjusted for the time period that has lapsed. So just like in last session, Asad was explaining that if a policy, if only half of the duration has been completed, we the premiums that will be treated as earned will be half the total. So for short-term policies, which include most general insurance products, medical insurance products, group life products, the definition of revenue is earned premiums. Whereas for most long-term, especially individual life products, where products that were covered by Shiraz in the first session, term life products, universal unit products, the definition of revenue is stated. The second important component of any insurance standard is claims. What the current standard requires is that claims should be recognized when they are incurred. Now you have to see this in contrast to when they are paid. So what happens is that a company might have paid a certain amount of claims during the year, but then at the end of the day, every year, there might be some claims that are still in under settlement, they're still reviewing it. Or there might be some claims which are not yet reported to the company, as I explained in this session. So what the standard requires is that you don't have to take just the paid claims, you also have to take the claims that are in process under settlement, and you also have to take claims that might be reported in the future. So claims are recognized when they are incurred. Moving to the next part, and this is again important because it is usually a significant amount, is the acquisition cost. This is to say in simple words, it is the commissions that a company has to pay on the policies. Similar to revenue, the current standard leaves a lot of room for discretion here. It can be, strictly speaking, the current standard does not prevent companies from deferring or not deferring for all types of products. So it can be deferred for short-term products and it can be deferred for long-term products. But the usual practice in the kingdom and in most of the countries in the region is that acquisition costs are deferred for short-term business and are not deferred, instead are recognized immediately for long-term business. Finally, the final component is the technical provisions, and we'll take a deeper look into this. And I just want to point out at this stage that the mechanism in IFRS 4 is such that it requires a lot of technical provisions to be calculated and uh, uh, and the movement has to be reflected in the P&L for us to calculate the correct profit figure. We'll dive into it in the next slides. Okay. So as per IFRS 4, because the requirement of IFRS 4 and when they are applied to short-term business, which is again most general insurance products, medical insurance products, group life insurance products, uh, there are various types of reserves that are required. And you might note that this list is very similar to what Asad showed us in his session. So on the premium related amounts, we have to keep a UPR, which is just reflecting the proportion of the premiums that are not yet earned. Then there is a deficiency reserve, which is the PDR. On the claim side, we have the reported claims or the outstanding claims. We have the unreported claims, and there is a provision for not enough reported, which means that if the claim has been recorded, but if you think the amount is going to change in the future, then you have to have a provision for that as well. Finally, we have the expense-related reserves, which are which can be either allocated expense reserves or unallocated expense reserves. And there in some cases might be additional reserves which are not strictly required by IFRS, but are sometimes required by regulations. So, for instance, in the Saudi market, there is a provision required called the reinsurance accrual reserve. This is related to any movements in commission income that you get. Or there is a provision required for data deficiency reserve, which is a provision required for if you have if the data is not of good quality. So there are sometimes reserves which may not be strictly required by the standard by IFRS 4, but are required by but might be required by regulations. Moving to long-term business, which is mostly for individual life insurance products. The first and the most important category is the mathematical reserves. This is also called the technical reserves or long-term reserves. And these include all the reserves that Shiraz discussed in his session. So this includes if there's a term product and you're doing the net level premium valuation for that, this will include the NLP reserves, or if you're doing the GPV for the endowment products, it will have the GPV. For the investment products which he discussed, it will also include the account value or the investment value in the mathematical reserves in most cases. And then again, also we can have the other premium related reserves, or all the claim related reserves can be there. Claims expenses can be there. Other reserves, if required by regulations, can be there. One important thing to note here is that for short-term business, as Asad said in his presentation, the most time-consuming or the most sensitive reserve is the IBNR. Whereas on the long-term business, the most sensitive reserve is the mathematical reserve. And that is why the focus for long-term business is always on mathematical reserves and not on IBNR. One important feature of IFRS 4 is the liability adequacy test. And the reason this is important is because the current standard does not provide much details on the basis of the calculation of technical provisions. And this will and in contrast, when you'll see IFRS 17 in the next session, you'll see that in contrast, IFRS 17 provides a very extensive methodology or very extensive principles for calculating the technical provisions. And this is the reason liability adequacy testing is important to discuss, because in the current standard, this is the ultimate guidance regarding the adequacy of liabilities. It does not have any further basis. So what basically this test requires is that the standard does not say that we have to follow a certain methodology, or we have to follow certain type of assumptions in calculating the liabilities. It just says that you can do whatever is appropriate for the business as long as you can show that the liability adequacy test is okay. So what it requires is that it requires to compare the insurance liabilities, test the deferred assets, and if they work out to be more than the expected net outflows, future outflows, then you're okay. It doesn't require any other analysis. So if your current liabilities are more than more than the cash flows you expect in the future, you're okay. It doesn't really matter what methodologies you used to calculate those liabilities. But if you, on the other hand, if you see the right side of the screen, if your current liabilities less the deferred assets are less than your future cash flows, then it is said that the liability adequacy test has failed and your liabilities are inadequate and you need to keep a PDR for it. And this test is basically the foundation or the accounting basis for the PDR, which was discussed by Asad in his Asad from an actuarial perspective. So moving to the next slide. Next slide. Basically, I think we have, especially because we might have people who have started working as actuaries or have done some internships. We talk a lot about technical provisions, but the question we need to think about is why do we need technical provisions in the first place? So from a balance sheet perspective, we need technical provisions because technical provisions reflect the value of insurance share and the insurance contracts. So on the balance sheet, we need to reflect what is the value of the contract that we have issued, what is the value of the contracts we have issued, or what is the value of the contracts that we have purchased for our own protection. And the technical provisions is basically the value that we need to present of the financial statement of financial position. From an income statement perspective, basically the reserves help you align the revenues and expenses uh, 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 when you're preparing the profit and loss account. So, for instance, let's build on from the example that was given by us. He said that if you issue a policy which has only completed half of the period, you should keep a provision of it, 50% of the premium as the UPR, right? And if you don't do that, what will happen is that if you issue a policy of 1,000 reals in January and issue a policy of 1,000 reals in December or in June, you'll book the income same for both policies. But when we keep a UPR of it, we basically adjust for the duration of the contract that has expired and take only the relevant revenues in our account. Similarly, if we don't keep the outstanding or the IBNR reserves in our accounts, what will happen is that the claims that we record in the profit and loss statement will only reflect the paid claims and will not be the complete claims or the complete incurred claims that are expected. So here again, if we don't do the OS and IBNR, it will basically give us an incomplete picture of our claims expenses and will overstate the profits that we have. Finally, if you don't do, as Shiraz discussed, there are some products which have investment values or account values, which don't actually belong to the company. They are just the policyholder's amount, which is which is with the company for investment purposes, right? If you don't adjust the P&L with the change in mathematical reserves, you will basically overstate the profit and will reflect this investment value in the company's profit or loss. So on the balance sheet front, technical provisions reflect the value of the insurance contracts that we have sold and the insurance contracts we have purchased. And on the income statement, it helps us keep the revenues and expenses aligned for time and and to avoid any mismatches. Okay, moving on quickly to the presentation of balance sheet under IFRS 4. Here on the left, you can see a typical balance sheet. This is basically, these are the main categories. These are obviously not the exact categories that company will be following, but these are the main categories. The first part that we see is the total assets. A company will always report the total assets at the top. And the second part is the total liabilities. And the third part is the equity. And people who have already studied some accounting would know that as a matter of principle, the total assets should match with the total of liabilities and equities. What's important to note here in the current practice is that the deferred acquisition costs and the reinsurance equivalent of it, that is the unearned reinsurance commission income, in today's practice are reported separately as separate line items on the balance sheet. And it's important to point this out because you'll see in the next sessions that this is one of the important changes in IFRS 17. Another important change of the same extent is the treatment of receivables and payables. So what happens today is that the company reports the receivables and payables, be it related from insurance or insurance contracts or any other source, separately on the face of the balance sheet. And here again we'll see is a significant change under IFRS 17 in the coming sessions. Finally, what's important to note, the third point is that currently all reinsurance share of technical provisions are reported on the asset side of the balance sheet, and all gross provisions are reported on the liability side of the balance sheet. So on the balance sheet, although for calculation and actually might look at the net technical provisions, but for the face of balance sheet, the insurance portion is shown on the asset side, and then the gross portion is shown on the liability side. Moving to the P&L, here again on the left you can see a typical format of P&L. It starts with the gross written premiums and subtracts the insurance premiums and then adjusts the net UPR to get the earned premiums. And other incomes are usually added to it to get the total premiums. And similarly on the claim side, it starts with gross, adjust the RI, and finally we have the policy acquisition costs, the GNA expenses to are subtracted to arrive at the income and loss before tax and SCA. Here, the two most important things to note are that the financial performance is reported on a net of reinsurance basis. So reinsurance premiums are subtracted from the gross, and reinsurance claims are subtracted from the gross claims, and the change in technical provisions is actually the net change in technical provisions, and the profit that we get at the bottom is a net profit after the reinsurance share. It's not from the face of the balance, from the face of the P&L or the income statement. We cannot see what was the profit and loss from the gross contracts and what was the profit and loss from the reinsurance contracts. Another important thing is the change in technical provisions. These amounts are usually big. You'll see in most of the actual statements for insurance companies that these changing amounts are very huge amounts in comparison to the other amounts on the P&L, and these do not provide insights into what is the nature of change. They just show you what was the change in the UPR, what was the change in the claim results, but they don't show you what was actually causing this change. And it is also helpful if you guys keep this in mind when you go to the next session. Anyway, we'll quickly wrap this session up by discussing the chart of accounts and few other things that are left. Basically, a chart of accounts, it's important to discuss because this will require significant changes after IFRS 17. What a chart of account is that it's basically a list of all financial accounts set up by a company for recording transaction. It's just literally a list of all the possible accounts they need. So it can be the premium account, it can be a premium refund account. On the asset side, it can be a separate account for invested assets, invested properties, all sorts of income, derivative income, investment income. It's just literally a list of all the accounts that a company has. These accounts are typically split into 5 segments or 5 categories. One is the asset accounts, which reflects the assets. Other is the liability. Third is the equity. Fourth is the revenue, and the last is the expense. So what happens is the first 3 categories, assets, liabilities, and equity, they go on to the statement of financial position. And the last 2 categories, revenue accounts and expense accounts, they go into the P&L or the income statement. Moving to trial balance. Trial balance is basically a report, or again a list, which just shows the balances of all accounts. Right? So just think of a chart of account as just being a list, and a trial balance is an extension to that list, which has the amounts for a particular period in front of each account. And those amounts are split into whether they are debit balances or their credit balances based on the nature of the account. And what happens is that these amounts are actually used to produce the financial statements. So we have a list which is called the chart of accounts. That list is used to record all the transactions throughout the year, which by the end of the year becomes a trial balance. Once the period is complete, you have the list and you have the amounts against those lists, and that list is or the report is called the trial balance. And from that trial balance, you basically produce financial statements. And that, in just in a few words, the process, the way it works is that from trial balance, a company sees that which accounts are asset accounts. Those accounts go on the statement of financial position. Which accounts are the revenue accounts? Those accounts go on the statement of income, and so on and so forth. It segregates those accounts and completes the financial statements. Just before we conclude, would like to point out some limitations and the problems of IFRS 4. Basically, IFRS 4 was an interim standard. It was never intended to be a final standard for insurance contracts. So what it did was that it left many aspects unaddressed, and because of that, it leads to significant inconsistencies between the financial statement produced by one company or by multiple insurance companies and insurance companies versus other industry. And some of the key aspects which were left unaddressed were the treatment of loss-making contracts versus profitable contracts. You'll see the significance of this when you see the new provisions of IFRS 17. Second thing, they did not tell us specifically or in enough detail as to how to deal with insurance contracts that have components. So we have seen that there's a main contract, then there can be a rider contract, and then there are some contracts with insurance investment components. So the current standard does not tell you exactly what to do about those type of contracts. It also does not give you too much technical details on the calculation of the technical provisions. As I said, it only really mentions the liability adequacy test. It also gives very limited details on the definition of revenue. We saw that 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 for short-term business it's earned premiums, for long-term business it's in written premiums. And just imagine if a company is writing both motor insurance and individual life insurance. This one company will be doing one thing for one line of business and another thing for another line of business. And finally, it provides very limited information on the presentation and disclosure of information on the financial statements. With this, I'll conclude the content that I have, and I would like to take any questions that you might have or any feedback that you guys might have. Okay, so we have a question here. It says that if deferred cost of acquisition is reported separately, doesn't that mean expenses are underestimated in profit and loss statement? See, it's presenting something separately is one thing, and reflecting it in P&L is one thing. So when I said it is reported separately, what I meant was that it's not offset against other technical provisions. So one way could be that you do a gross UPR and then you minus the deferred liabilities from it. You still get the same net amount for the statement of financial position. And other ways that you report the UPR as it is and show the deferred acquisition cost separately. In both cases, you'll still get the same net amount. As far as the expenses are reported on the P&L, as long as you just adjust the deferred acquisition cost once and correctly, it should not underestimate. It just differs basically. It just means that you have incurred something which was actually meant to be covered over the life of the contract, and you just spread that out to ease the pressure on the profit and loss statement. I hope I have addressed your question correctly.
Yes, Osama, I think this is all the questions. If anyone have any question, he can write it in the chat and we can answer it later. Thank you so much for this informative presentation. It was a very excellent presentation, and we now should go forward to our next presenter, Muzammil Ahmed.
Thank you, guys. And if you guys still have any questions, just drop me a message in the chat. Thank you.
Hello. Hi, everyone. This is Muzammil Ahmed. I'm going to start my screen share. Can you please confirm that you can hear me?
Yes, Muzammil, we can hear you, but we can't see your screen. Can you share?
Yeah, I have not yet shared. I'm just going to share it. Can you please confirm that the screen is visible to all?
Yes, your screen is visible and your voice is clear, so you can start. Go ahead.
Thank you very much for joining it, and I thank the presenters who have already presented. So now I will be focusing on the requirements of the new standard, IFRS 17 standard. In case of any questions, do please put them in the chat box, and I'll try and save as much as time I can for the question answer sessions at the end of my session. So so basically, as you have already, of course, seen through the presentations that we have, like IFRS 17 is an accounting standard, and it basically guides the insurance companies into developing these their accounts and the presentations and the financial statements and all of that. So and obviously, in order to be able to achieve that, as you saw that in the last session, accounting, Osama basically detailed and explained that there are many disclosures, financial statements that have to be shown. He was talking about IFRS 4 perspective. They are modified, but still you have to have the income statement, the balance sheet, and certain disclosures. Of course, in order to be able to show the numbers in that, you have many actuarial calculations, which have been detailed in the previous 2 sessions. But I will be working on the basis that they have laid, and I'll just be showing what IFRS 17 requires from those. So without any further ado, let's move on. So these are some of the keywords and definitions. So I will be using them in the future in my session. So essentially, I would just want to take a minute or two to just explain this to you all. So IFRS 17 is obviously for insurance contracts, and insurance contract as per IFRS 17 is where one party, the insurance company, accepts a significant insurance risk from another party, which is the policyholder. And the company actually agrees to compensate the policyholder if an uncertain future event has occurred. So in Asad's presentation, we saw that these contingent events basically are death or morbidity in the life side, and contingent events can be accidents or illness in the medical and other fire or anything in any sort of like insurance that you have seen. Following that, you have a portfolio of insurance contracts. So I'm just going to detail it a bit more in the next few slides, but just for the concern, a portfolio of insurance contracts from IFRS 17 perspective is a collection of contracts that has the same risks, and they are managed together. So these are the 2 things. I'm just going to give further examples so you would be clarified on this further. One of the I would say one of the areas, one of the additional areas that is in IFRS 17 is the new type of liability, which is contractual service margin. We'll be using this terminology over and over again as we discuss measurement models. So I would want you to get used to it. In essence, it is the unearned profit. So as you sell a profitable policy, let's just say you sold it and you are expecting a profit of 1,000 on that policy or a group of policies, 1,000 currency units. So that unearned profit, as you saw in Osama's presentation in IFRS 4, it's not there in the profit and loss or liability balance sheets. But this is a separately held liability in IFRS 17. So you have like it is developed at the inception, or maybe for currently in force business, it may be set at transition, but then it moves on, like it's rolled forward as to the amount of profit that is not earned. So you can only imagine, if there's a long-term policy, you will have an estimate of CSM in the beginning, and then as you move on, you would have like a smaller amounts of unearned profit, because you will be earning the profit as well. Insurance risk is defined as any risk other than financial risk, which is transferred from the policyholders to the insurance company. This is very simple. And then you have fulfillment cash flows, which is these all its statements are going to come forward as well. But just to explain, they are unbiased probability weighted estimates of the present value of future cash flows. And they also include a risk adjustment for non-financial risk. So what I mean to say is that this fulfillment cash flow essentially consists of 2 distinct components. One is the present value of future cash flows. So this is of course built up on what we used to do in IFRS 4 as well. And as Shiraz's portion of the presentation showed, we have projections made, and we take an expected present value of the future cash flows. That is one part of fulfillment cash flows. The other part is risk adjustment, which is again a new thing. Now, it is quite comparable to the risk margins that we used to hold in IFRS 4, like in conservative margins, but it's still a new thing that you have to hold in order to complete the fulfillment cash flows, which is defined just below, is that risk adjustment for non-financial risk is a compensation an entity requires for bearing uncertainty about the amount and timing of cash flows. So it's like it's another liability component that the company holds, and then obviously that is also released with the time to the profit and loss. So moving onwards, IFRS 17 has many requirements. Obviously, it is an accounting standard, a tall document. You can obviously find it on the internet. But in the essence, the major requirements can be, right now, basically, I will not be touching each and every aspect of IFRS 17, but the major requirements can be basically outlined via these four classifications. So the first one is the grouping and classification requirement. That will be my first agenda. The second one is measurement of the liabilities. So how do we measure the liabilities? Now, some of it you have seen in the life and non-life sections. We use to measure liabilities for IFRS 4 as well. How did we measure the life liabilities, and how did we measure the non-life liabilities? You have already seen that. Some modifications will be made to that. And then you have the reinsurance requirement. So IFRS 4 essentially did not separate them very clearly. So you would see most of the numbers on the net basis. From now on, basically, in IFRS 17, you have to segregate it. And then finally, we have the disclosure requirement. So Sama gave you an accounting output. I would not be going accounting outlook. I will not be going that much into detail, but I'll outline the requirements that IFRS 17 has for these disclosures. So the first thing, as I said, is the classification of insurance contracts. So previously, we did not have like such, this is a very, like say that this is a very unique aspect of IFRS 17 in which you can see that IFRS 17 requires insurance contracts to be classified into group of contracts. So you wouldn't, although it is allowed to go granular, but you have to classify all of the insurance policies that you have, and you have to classify them according to these three categories that you have. So we have already discussed the portfolio that first tiers. So let's just say a company has 1,000 insurance policies. So first thing that it will do is it will bundle them as per the risks and the management. So let's just say all the term policies have the same risk and they are managed together. So they will converge into one portfolio. Similarly, you can think that if fire policies are there, all of them will converge into another portfolio. Investment type contracts will converge into another portfolio. So you can see that the portfolio has each portfolio will have homogeneous risks and they will be managed together. So that's one of the areas. The other area is profitability. So when you have classified them into portfolios, now within each portfolio, you will see that there are some contracts that are profitable and some that are not profitable. So as we go on, I'll detail these, but the profitability classification will be, so they will be homogeneous as per risk and the management, but they will not be homogeneous. They will have different profitability characteristics within a single portfolio. And then once you split them as per profitability as well, within a single profitability group, there will be contracts that will be issued in different years. So IFRS 17 says a group of contracts cannot have contracts that are issued 1 year apart. So let's just say if I issue a contract in 2021 and then another one in 2022, these two cannot be a part of a single group of contract. So these, based on these three tiers, you make a single group of contract. And IFRS 17 usually asks you to carry out all the measurements. So you saw the measurements previously as well, right? You have the cash flows, you have the UPI, you have different types of workings. IFRS 17 generally recommends that you do this on a group of contract level, which means that you do it for contracts by bundling them into groups of contracts, which will have the same portfolio, the same profitability, and the same issuance year. These three combined, if I have like 1,000 policies, I may get a group of contract that only has 25 policies. So I will measure these 25 policies together as per IFRS 17. But you can obviously go more granular, which means you can go policy wise. or in case of practical reasons, you can also go higher, but the recommended approach is to stay on the group of contract level. So I made this is a very simple example. So as I said, an insurance company has, let's just say, motor business, medical business, and life business. Now I'll just make life business a single portfolio. So you can see that you have a single portfolio for life, and then within that you have 3 profitability categorizations as defined by IFRS 17. Onerous contracts are those that are loss making. So obviously a question arises, why would a company sell a loss making contract? So there can be a few reasons for that. First of all, the company's pricing is done on a modal point basis. So you can see that you do not test every single age, sum assured, and everything, every combination characteristics that affect the price. Just to give a very simple example, let's just say we have a simple term policy. So the term policy, and let's say the 2 major variables that will affect the price is the sum assured itself and the age of the policy holder. But you can see that I cannot carry out my pricing from all the ages from, let's say, 18 on to 100 or 80. So this is why we have certain policies that might not be captured by the modal points, and they might turn up to be onerous. Another reason might be that the company is strategically underpricing a certain group. So maybe it's a very big business and the company wants to write it. So it might give them a discount sort of, which may initially turn the company, the product onerous, and then it will convert profitable. Its profitability will come around. So these profitability taggings, and then let's just say we write this life term products for, let's say, 10 years. So each year will be a different group, and then we have 3 different obviously profitability categorizations. So only for the life portion we will have 30 groups of contracts. For onerous, year 1 to 10. For not onerous and no significant risk of becoming onerous, year 2 to 10, and then other year 1 to 10. So these will be 10 each, and we will have a single portfolio. We will have 3 profitability categorization, but overall we will have 30 groups of contracts. This is obviously level of aggregation. This entire talk you would not find in also. I see some questions in the chat. I will just answer them in the end of the question session, but I encourage you to put them in so that I know. Now IFRS 4 did not have any specifications such as level of aggregation. So typically what the companies would do is, if they have, like in individual life, they have 2 types of products, term life and unit link, and they will aggregate them both and convert it into like they would measure it, and they would present it as an individual life product, individual life portfolio, or the individual life group. But that is obviously not essentially necessary. It's not right for in terms of IFRS 17, because portfolios would be collection of homogeneous risk policies. So term would be a different portfolio, and unit link would be a different portfolio. These will have different risks, because term life has different risks, and unit link, as Shiraz explained, it has different risks from the company's perspective. So this will no longer be entertained in IFRS 17. IFRS 17 will have to have like a segregation between these 2. So different types of risk will no longer be measured together. Now, you can see that the classification of these insurance contracts will change. And as it changes, obviously there will be some impacts. So first of all, as Osama explained, that in accounting, there were different liabilities. And as I just showed you in the previous slide, initially, like in IFRS 4, all of this would be shown under individual life. But now individual life business itself might have different portfolios. So the accounting would have to be done on a portfolio level, and you will have to basically show the results. Although obviously on a company basis, you will be consolidating them, but you will have to have the CSM and all of that measured and segregated. So that will be one of the accounting impact. Then a process for regular update of chart of accounts. So as new groups are added, new cohorts are made, because profitability classifications, because every issue here is a different group. So these all will have to be updated in the chart of accounts. So just to give an example, you will have to keep track of CSM of portfolios. So if you add more products, different risk types, you will have to have a separate account for them. Administrative system impact is that IFRS 17 has become very computation and data intensive. So you can only imagine, as I just explained you, that in a certain level of aggregation you will have, when you previously used to have only life. Let me just go back to that slide as well. Previously you just had used to have life here. Now instead of life you will have 30 different groups for which you will have to calculate and obviously keep separate the CSM and the remaining liabilities as well. So it will be a very intensive, the system impact would be very intensive. And obviously for that you will have to keep track of these contracts. So let's just say I make a group of contract consisting of, let's say, 20 policies. I will have to basically keep track of these 20 policies separately and the other 20 separately. So it will be very, the system will have to have the capacity to follow these, because initially in IFRS 4 systems, you would only have one line of business, maybe just general accident, maybe just liability. So these all will have to be made more granular, and you know that making more granular means more data to hold, means more obviously processes to validate and all. And of course actuarial model impact, this will be detailed in the following slides as well, but actuarial modeling has changed considerably. So obviously, initially we had like life on the policy level, and in the PNC will have, like they used to have on an aggregate level. The two things that would have to change is that maybe you can consolidate the life reserves from a granular level to a group of contract level. But of course, in case of PNC, there would be, in terms of liabilities, they would have different risk adjustment calculations, even in life and non-life both. And of course, cash flows will have to be generated in order to apply discounting. Now, usually life products, as Shiraz showed in his presentation, is that they have like they have this excuse me for that, they do have like these cash flows made already and discounted. But in non-life this didn't used to happen, but now it would have to be carried out. So following that, I have obviously, as I said, the second tier is the measurement of liabilities, and how IFRS 17 details different types that we have to entertain. So for every group of contracts, there would be, or let's just say we are working on a portfolio level. So every portfolio, we will have the total liability, which will be made up of two components. The first is liability for remaining coverage, and the second is liabilities for incurred claims. Now, liabilities for remaining coverage is simple as for the services that you have not yet provided. So I can basically, you can consider it a prospective measurement and of the liability. So what liabilities I need to hold, what reserves I need to hold in order to provide the services in the future. So the services are not yet due, they have not been incurred, so a claim has not arrived yet, but obviously either you have already received the premium or you will receive the premium in the future. So in order to count for those liabilities, you have the liabilities for remaining coverage. The simplest example is the UPR, which obviously Asad discussed, is that let's just say I received a 1,000 premium upfront and I have not yet provided any service. So that entire 1,000 currency unit will be in my UPR. That would be my liability for remaining coverage. Of course, liabilities for incurred claims is for something that has already happened. Maybe the company knows about it, or maybe it does not. So an example would be outstanding claim that Asad explained as well, is that what I've written here as well is let's say a claim has occurred but has not yet been paid. So that claim amount, let's say it was also 1,000 currency unit, will have to be held in the obviously in the balance sheet. And IBNR again is one of the type of reserves that that is to do with LIC. Now, this composition of LRC and LIC, it usually has a best estimate component and a risk adjustment component. So as I explained, the best estimate component is the future, the unbiased estimate of what would happen, what kind of reserve I need, and then I will need the risk adjustment for both of these liabilities, first of all. Second of all, the nature of these liabilities will depend on two important things. One is the type of contract. So the type of contract we have already discussed before. The profitability type will determine what kind of liability we have to hold. For profitable contracts, we have a CSM and the fulfillment cash flows that makes up the LRC, and the LIC remains the same. For non-profit or onerous contracts, we have just the fulfillment cash flows. We do not have CSM because we do not have any profit. So there would be no unearned profit. And the LIC obviously is the same for both. And secondly is what method you are using. Either the measurement model is GMM, VFA, or PAA. They are coming obviously in the following slides, but just to remind you that the type of liability, the nature of liability that you are holding will depend on two important things. One is the profitability classification of the contract, and the second is the measurement model that you apply on the contract. These two things will determine what kind of what will be in your LRC and what will be in your LIC. So the basic measurement model that IFRS 17 basically tells you to use is the general measurement model, which is also called the building block approach. Now, on that general measurement model or building block approach, you can apply the optional or require optional simplifications or certain modifications that are required to then get the other measurement models. So this is the base model, general measurement model. I will detail it in the next slide, but this is the base model. And if I apply optional simplifications for the short-term contracts, it will come down to premium allocation approach, which is the simplest of the models. If I have any accounting modifications related to reinsurance, then it would be obviously a modification required for accounting in the reinsurance. And if I apply adjustments required for direct participation features. So direct participation features has a few conditions. Obviously, I'm not going to detail them right now. But what I will say is the unit link contract that you saw in Shiraz's basically presentation was one of the contracts which will be measured under variable fee approach. So as I detail it, just when I talk about VFA, just it should click to you that it is from the that unit link is one of the contracts that is measured under this specific approach. So moving onwards, as I said, the three basic models, the GMM, VFA, and premium allocation approach, where VFA is a modification and premium allocation approach is a simplification. So all the products that are mostly life and that are more than 1 year for general, they will be measured under GMM. So you have a list of contracts that can be, or portfolios that can be measured, level and decreasing terms, non-participating endowment, you have engineering long-term policies, you have got group credit policies. So all such policies, they are in non-life, they will be long-term, more than 1 year. So Asad mentioned that most of the non-life is 1 year, but there are still some contracts that are more than 1 year. They will be measured under the building block approach. As I mentioned right now, that variable fee approach is a necessary modification to account for direct participation features. Now, what I mean by this is you saw in the unit linked example is that the insurance fund and the investment funds, they were two distinct components, but the insurance fund was dependent upon the investment fund, directly dependent. So whatever you are paying to the policyholder is directly dependent upon the underlying investment of the policyholder. So a very simple example can be, maybe you promised a sum assured of 1,000 minus the account value. So 1,000 minus account value means if the account value is very good, is performing very good, so it crosses 1,000, you will not have to pay anything to the policyholder. So, and if it is not performing very well, then you will have to pay to the policyholder. So in that situation, you can clearly see that there are high dependency between, and you cannot, that kind of dependency you do not see in the basic term products or non-participating endowment products. And premium allocation approach, as you can see, is for 1 year. The contracts, the rule of thumb is if the contract is less than 1 year, you can apply premium allocation approach directly. Otherwise, you can obviously have like some criteria. So if you have eligibility testing, but what we right now see, the contracts that are mentioned below, they are short-term contracts. So they are less than a year. And that's why they are measured under PAA. And the last thing, obviously, as I mentioned, is that the nature of liabilities will also depend on this model as well as the profitability type. And GMM and VFA have sort of different, similar liabilities. I'll detail that in a later slide. So the first thing that we basically have is the premium allocation approach. And premium allocation approach, as I said, is a simplification applied. So the eligibility criteria, as I said, is any contract that is issued or a group of contracts that is issued for a duration of less than 1 year or 1 year or less than 1 year. That would be straightforward included in your PAA. Otherwise, you can check if you have a contract, let's say it is more than a year, but still you think it's let's just say it's for only 16-18 months. So you can check if the GMM, the general measurement model, and PAA, premium allocation approach, they are giving somewhat the same liability figures for the contract. Then you can apply this the simplified approach as well. So either the contract is less than 1 year, or you check that the difference between the liability is not significant, then you can go for the PAA. Now the liability under this specific PAA approach, again, as I said, it's LRC plus LIC. Now, as Asad also mentioned, that for non-life, which is mostly short term, most of obviously the most important reserves are the liabilities for incurred claims. The liabilities for remaining coverage, you can see it's the same unearned premium less deferred acquisition cost. So it's the same as we used to have for IFRS 4. A few obviously tweaks will here and there, maybe the deferred acquisition cost or maybe some impairment testing. These are obviously some small nitty-gritties, but from a broader perspective, you can see that you're still keeping the UPR that we calculated in, obviously that we saw was being calculated in the non-life section. And even for life policies that are less than 1 year, if they are measured under PAA, you just keep a UPR, you subtract DAC, and that will be your LRC. So for PAA contracts, a greater emphasis or the more critical liability is this essentially is the life. All right. Am I audible? Hello, I was just muted. Am I audible? All right, thank you. So, and in case of PAA, obviously, if it is a loss-making component, loss-making contract, of course, if you have like in your situation, if you have a classical example of a PAA short-term contract becoming loss-making can be when you have like discounts provided to a large group of contracts. So in that case, you might get a loss component as well. So that is obviously what the loss component that is set aside for this type of contracts is you calculate the liability under GMM and you calculate the liability under PAA, and the difference between the two is set aside as the loss component. So then the LRC will become the unearned premium less deferred acquisition cost plus your loss component as well in case of onerous contracts. Now liabilities for incurred claims again is a best estimate plus risk adjustment. Now the best estimate, if I clarify it, would be outstanding claims and incurred but not reported, or incurred but not enough reported. So the type of claims, the type of claim liabilities that Asad mentioned are still there. You still hold outstanding claims, you still hold the IBNR claims, and you hold on top of that a risk adjustment. So the only difference here in IFRS 17 is that we can discount the liability, although we have an option that if 1 year or less, if they are paid in 1 year or less, no discounting is needed. So what it means is, obviously in certain, you can say in certain lines of business, maybe in especially in liability lines of business, you can say that the claim was incurred in a single year, let's say 2020, and it may take a lot of time for the claim to be paid. So in that case, obviously you will have to discount that liability. You will have to discount the outstanding claim and the IBNR as well. But let's just say if it is motor, where obviously claims do not get dragged on, like they do not have like a very long settlement period, they have small settlement periods. So in that case, you do not need to discount the liability as well. So if it is happening within 1 year, it's a general rule in IFRS 17 that you need not discount the liabilities. And of course, in IFRS 17, in every essentially in every measurement model, you can say the assumptions are kept current. Current means that every time you have to update the discount rates, the risk adjustments, and as we move on to longer term contracts, you will have to update the decrement rates as well. So you may have a different mortality, you have to update it. You may have a different rate of claim incidents that you have to update. So every year, every reporting period, you have to update your assumptions as well. Okay, the risk adjustment for LIC under PA, and of course for others as well. Risk adjustment ahead for LRs, for GMM and VFA is obviously explained in the forward slides as well. But for LIC risk adjustment, you can say that IFRS 17 does not prescribe an approach. So you do not have an approach prescribed that you have to follow this method and then you have to get the risk adjustment. It can be as simple as a percentage add-on, which means, let's just say if I have an outstanding claim of 1,000, I can have a 10% add-on, and that would be it. That would be considered my risk adjustment. Obviously, I'll have to justify it, but it can be as simple as that. And it can be as complex as a stochastic modeling of my underlying claims, and then I calculate a VAR or a percentile or a conditional tail expectation. So that is no prescribed risk approach is there. But obviously you have to have explicit risk adjustment, which means you have to have an additional item called risk adjustment, and you will have to keep it. Of course, risk adjustment has to allow for this diversification. So you know that obviously risks, they have offsetting properties. A very classical example that is revolved in actuarial sciences is mortality and longevity. So even if a company has, let's say, insurance contracts and annuity contracts, an increase in mortality will lead to more payouts in insurance contract, but less payouts in annuity contracts. So this is sort of an offsetting, this is called diversification of risk. And obviously it can apply to many other situations as well. So that has to be catered into risk adjustment. And of course, methodology and the percentile of risk adjustment, the confidence interval of the risk adjustment has to be described or disclosed. As we look at the disclosures, you will see that. And of course, as I said, risk adjustment is disclosed in the IFRS 17, and obviously it will have an impact in the income statement. So management, of course, it's reasonable for the management to look into it and understand it clearly as well. Now I move on to the GMM and VFA. So right now what I discussed was PAA. GMM and VFA are approximately the same liabilities. At inception, they will have like, and obviously at a subsequent measurement as well. So they would have like typical 4 components. First is best estimate cash flows. The second is time value of money, because those cash flows have to be discounted back to current estimate. You will have to have the risk adjustment. And now this present value of future cash flows and risk adjustment, they make up the fulfillment cash flows. And finally, you will have the unearned profit, CSM. So you can see that in PAA simplistic approach, LRC did not have a separate CSM. It is a simplified approach. So any premium that you are keeping, you are setting it aside for the liability for remaining coverage. But in the GMM and VFA, you have to project the premiums, you have to project the benefits, you have to project the expenses, you have to take the net outflows, you have to charge the risk adjustment, and then calculate the CSM, and then you roll forward the CSM. So this might come, obviously, this might this all might be a very I would say it might be a very flooding thing, but let us just go one by one. So the fulfillment cash flows consist, as I said, of two things. First is the future cash flows adjusted for time value of money, which is the present value, which we have seen in Shiraz's presentation as well. You calculate the net outflows, you calculate its expected value, then you calculate its present value. And then obviously you have the risk adjustment. So risk adjustment, again, as I said, for LIC, I have already explained. For LRC, I'm going to detail here, because under GMM and VFA, most, as I said, most of the contracts under GMM and VFA would be for life, for individual life. And you can see that for individual life, LRC, or as Osama mentioned, mathematical liability is a more important or a more critical reserve. And LIC, obviously, since life incurred claims are, unless it's an annuity type claim, life incurred claims are usually cleared in a short time. So that's why the LIC is very small for this life type product. So for GMM and VFA, we will be focusing more on the measurement of LRC. The LIC measurement remains typically similar in all sorts of the measurement models. And in LRC, so the fulfillment cash flows and the CSM. So initial and subsequent measurement are same for GMM and VFA for fulfillment cash flows. So the fulfillment cash flows for these two models are the same. The initial measurement is different for and initial measurement of CSM is also the same, but subsequent measurement of the CSM is different for GMM and different for VFA. Now, basically a very striking difference between these two is since VFA type products, they basically depend a lot on underlying items, as I have explained, right? So they have investment types, and they basically the what we can say is the amount of expenses in benefits, the amount of benefits that the company has to pay, it will depend on investment performance as well, very, very much in case of VFA. Of course, the investment performance does affect GMM, but directly in VFA. So in order to account for that variability, additional variability, the CSM adjustment is a bit different in VFA. This is obviously a more detailed topic, and from a broader perspective, this is the reason why their subsequent measurement would be different. Now, the first thing is obviously future cash flows. Now, future cash flows will have unbiased probability mean. They will reflect the perspective of the company. They will be current, and they will be unambiguous, explicit. So, for example, everything that is that can occur should be accounted for. So in a life contract, if I talk about the unit link policy that you saw in Shiraz's session, there can be mortality, there can be morbidity, there can be surrender, there can be partial withdrawals, there can be maturity. So these all 5 outcomes should be in my future cash flows. When I project these cash flows, as you saw Shiraz's projection, there were mortality claims, there were surrenders, there were maturity claims as well. Morbidity, I guess, was not there, and then expenses as well. So all of these cash flows have to be considered when you are projecting and calculating the future cash flows, expected future cash flows. And another thing is they should be in the contract boundary. Now, in simplistic terms, contract boundary is the term of the contract, very simplistic terms. But of course, in IFRS 17, obviously, as an accounting standard, it has to account for all the nitty-gritties and all the, what we can say, the unique situations that may occur. So in some situations, the risk may start prior to inception, and then it may end before as well. So these situations are not very common, but what contract boundary means is that the company can compel the policyholder to pay the premiums, which means the policyholder is in the contract, he has to pay the premiums. And the policyholder, on the other hand, can compel the company, or company is obligated to pay the claims as they occur as well. So this is the contract boundary situation in IFRS 17 terminology. But for very simplified cases and many policies, this can be considered as the for insurance contracts issued, it can be considered as the term. But obviously we can see in the reinsurance section, this would be a bit different. So the last line addresses that point. When I reach reinsurance, I'll explain. Next thing in the liability for remaining coverage calculation is the time value of money. So once you have obviously projected the expected values of all the inflows and outflows, accounting for all the possible decrements and all the possible expenses, benefits, inflows and outflows that may occur, what you would do is you would then take the present value of these items. So in obviously GMM and VFA, they are long-term contracts. So since they are long-term contracts, you have to discount them back. So discounting is necessary in GMM and VFA. And obviously discount rate is something which we have studied. Obviously financial mathematics is very simple. We can calculate the annuities present value. We can calculate a single payments present value right now. But the discount rate, I'm not going to detail the present value calculation. Shiraz has already done that. But the discount rate that you use in as per IFRS 17 should have three characteristics. First is it should reflect the time value of money characteristics of the cash flows and the liquidity characteristics of the contract. So time value of money characteristics, as I said, is that if you are receiving a premium of 1,000 right now, and you are receiving a premium of 1,000 a year from now, 1 year later, you can obviously the financial mathematics and the theory of time value of money says that right now what you are receiving is greater than what you will receive a year from now. So that's one of the characteristics. Second characteristics is it should be obviously should contain the liquidity characteristics as well. So you can obviously see that for illiquid contracts, the discount rate would be higher because naturally a premium would be charged. Consistent with observable current market prices, which means that of course it should be consistent with the market discount rates as well. And third is the exclude the factors that influence observable market process, but does not affect future cash flows of the contract. So maybe credit spread on the bonds is affecting the market yields, but it would not affect the cash flows of the insurance company unless insurance company itself expects any defaults, credit defaults. So that will have to be excluded from the market yield curve in order to achieve at the desired discount rate. And obviously flat discount rates are usually not very reasonable. So you will have an entire yield curve. Yield curve means for every year what is the discount rate. So maybe you will have for 2018, this is the discount rate, 2019, let's say 4, 5, 6, 7, 8%, and you will have 2018, 19, 20, 21. So this is how a yield curve goes. Now risk adjustment for essentially for the liability for remaining coverage. Now, as I've already mentioned, it's a compensation to the company to basically be indifferent between these range of possible outcomes. As you know, as I said, there are a range of possible outcomes. A person, let's just say, for non-life contracts, a claim may occur, claim may not occur, and obviously the amount of the claim is again unexpected, or a range of outcomes may happen in there. So risk adjustment is a compensation for that. Again, it should be, in order to reflect the diversification, it should be developed at a group level and then consolidated up to the portfolio and even entity level in order to get the diversification benefits as well. Of course, in terms of long-term contracts, all the risk, mortality, lapse, expense risk, and surrender risks, all of these risk, interest rates, lapse, expenses, and mortality, and other non-financial risks, they should be considered. Morbidity is there. So these are all the risks that should be considered in the risk adjustment. Now, the possible methods, I'm not going to illustrate these methods, obviously, because they are all very detailed. But the second and the third one, you can easily, obviously, you know that you have seen it in the books of, or in your primary statistics course. So you have value at risk, where you actually draw up a distribution and you calculate a single percentile. or you can have a conditional tail expectation, which means the average of all those observations greater than the percentile. And then you have stochastic approaches to fit the distribution as well. So you can have the MAC method, a Monte Carlo simulation, or a bootstrapping, which is also a type of simulation. So using these simulations, you can either calculate a simulated percentile or simulated CTE, or you can have a distribution like log normal, and you can calculate that. So these are the ways in which you can calculate the risk adjustment at a certain confidence interval. All right, now risk adjustment is one of the newer things, as you know, and then comes the CSM. Now CSM, as I have mentioned, it represents the unearned profits recognized over the coverage period for the insurance contracts. Now CSM is whatever so if you have expected present value of cash outflows minus expected present value of cash inflows and risk adjustment. So what it is doing is outflows plus risk adjustment, and you subtract the inflows. So what I'm trying to say is, if you are expecting a policy or a group of contracts to give you more inflows in terms of premiums, and then take away from you or a lesser in outflows. So outflows would be in terms of obviously the expected outflows, expected claims, expected expenses, expected commissions, or it may be the risk adjustment, which obviously which can be considered as the unexpected portion of these things. So as I mentioned, the risk adjustment is for obviously we have a range of outcomes, so we keep risk adjustment as a buffer. So that buffer again is why this is this all is because it's for the unexpected portion of these outcomes. So once you subtract from your inflows the expected and unexpected portion of the outflows, what you get is your CSM, which is your unearned profit. So whatever is remaining is your profit for the company. So that is what a CSM is. And in case of a loss component, it is actually reverse, which means the outflows will be higher than the inflows. So a loss component would be developed. And although CSM is amortized, essentially uniformly or throughout the periods of the policy. So for example, if I have a CSM of 1000 and a 10-year policy, I cannot recognize entire CSM at the inception. I will have to release it properly in my profit and loss account. But loss component is obviously recognized upfront, which is obviously one of the criteria that IFRS 17 requires. Second is for reinsurance, as I said, is a bit different. So for the insurance contracts that you have issued, you will have either a CSM or a loss component. So in case of net the outflows being higher, there will be a loss component. But for reinsurance, there will be a negative CSM as well. And subsequent measurement, obviously, CSM would be, the previous CSM would be taken. It would be adjusted for the interest accretion, any experience adjustment that has happened. So experience adjustment generally account for things that you had not accounted for. Like it has the things that you were expecting. Let's say you were expecting 2 deaths and instead you only had 1. So these are the type of adjustments that you will have in your CSM. And obviously the release to P&L will also be adjusted in the CSM amount as well. So just as an illustrative example, I have a profitable and an onerous contract. Excuse me for a moment. Now you can see the premiums are 900 for the first case and the outflows are 755. So you can see contractual service margin of 145, and you have a fulfillment cash flow of 755 minus 900. So you can see that the liability at inception is 0 because minus 145 is your fulfillment cash flow and positive 145 is your CSM. So we'll have IFRS profit and loss is 0 as well. Now on the contrary, you can see that you can see that you have cash inflows of 700 and again the outflows of 755. You can see that there is no contractual service margin because we cannot keep a negative CSM for insurance contract, but there will be a loss component of 55, which you can see here. It is recognized directly in the profit and loss, and a liability of only 55, which is fulfillment cash flow of 755 minus 700. So instead of keeping a CSM negative, you directly recognize it in the profit and loss account. Now, moving on, we will have the reinsurance portion. Now, before I move on to that, you can clearly see the distinction between IFRS 4 and 17. You can see that IFRS 4 only had the first two components, and even in that, you did not have like very explicit directions for the future cash flows, which means you did not have to, although the company's practice are usually that they update the assumptions and they make it current, but there was no explicit requirement. IFRS 17 marks for an explicit requirement. You saw that the risk adjustment for both types of claims, for both types of liabilities, incurred claims and remaining coverage, both are set aside explicitly as a margin for unexpected outcomes. And you can see that in case of a profitable contract, you are not just allowed to put everything in the profit and loss in the first go. You cannot just say that, for example, in this 145 case, you cannot just recognize it in the profit and loss account. You will have to create a CSM as a liability, and maybe with every year you will earn some of that profit. So as I said, if it is a 10-year contract, you will start with 145, and then at the end of the contract you will have 0. You will keep on earning, releasing it to the profit and loss sequentially. So you can see that it's a very detailed outcome, and as you will see in the profit and loss account as well, it is very transparent. From your liability, initially you only had one single line, mathematical reserves for the profit and loss, and for life contracts, and for non-life contracts you have IBNR and outstanding claims. But now you will have separate everything. So you will have the best estimate. You will show how much the impact of discounting is. That is also necessary. And you will show how much of a margin I am keeping for risk adjustment and how much is the profit that I am expecting for that contract. You can only see that in the liabilities only. You can see that the clarification is so much that it can be read and easily. Okay. So let me now only few slides are left. So let me complete them and then I'll return to the questions that are waiting for me in the chat. Right now, you can see this is a reinsurance versus issued contract. So obviously, reinsurance is insurance of insurance. So you cede a portion of your what the insurer is doing is ceding some of its risk to the reinsurer. So in that case, obviously, it's quite similar in terms like in if you think about it, there would be premiums, there will be claims. Of course, there will be a CSM as well. But IFRS 17, obviously, regarding the nature of the reinsurance that there is, it mentions certain differences, and that I have done here. So reinsurance held can be measured from different models than the counterpart insurance contract. So maybe your gross, like your insurance contract that you have issued, it is maybe it is measured under PAA, but its insurance can be measured under GMM as well. So a situation where it happens is that I am just going to combine the contract boundary concept right here in the middle box and the measurement model concept. So the contract boundary concept, as I said, is the duration. For the simplest terms, it's the duration of the policy. So let's just say I have a motor contract, which is 1 year. Now, when companies reinsure, they do not reinsure usually a single contract. They insure like all the contracts written in this type of risk. So let's just say I keep on writing contracts from 1st January 2021 to 31st December 2021. My contract boundary will remain 1 year for each of the contracts, but the reinsurance contract covers all of these contracts as well. So all these contracts are under one reinsurance contract. I have one reinsurance treaty for all these. So if you now typically think of it, my reinsurance contract will start on 1st January 2021, but it will not end at 31st December. Because on 31st December, the policy that I issued for motor will run another 12 months. So you can only see that your reinsurance contract will start on 1st January 2021 and it will end on 31st December 2022. So in that sense, you can see that the reinsurance contract automatically became 2 year long, and hence it does not fall under PAA. It may go in GMM as well. One area where a reinsurance contract is distinct is that it will have like VFA will not be allowed, because you can only understand there are no underlying items or investment components that the reinsurance is dependent on. It's pure risk sharing and not investment. There are usually no investment components. The grouping again can be different, although the same profit, the 3 tiers that I mentioned in the level of aggregation, they are the same, but they can be different from the cross. And the CSM obviously can be positive or negative. There is no loss component. You do not have to recognize all the losses in the first go. There can be a negative, and it can be amortized. And of course, the recognition rules are a bit different. Obviously, for insurance contracts, beginning of the coverage period, earliest of the beginning of the coverage period, date when a first payment from the policyholder on the group comes, and for a group of contracts when it becomes onerous. So this is from the perspective of a group of contracts which might have multiple policies. So we'll start at earliest of these 3. Whereas proportional, beginning of the coverage period of the group. So underlying contract, as they start, the coverage period for the reinsurance also start. And for non-proportional, obviously it starts as the reinsurance treaty starts. So these are few areas where we can have. Another important difference between the the insurance and reinsurance contracts is the risk adjustment. So as I just told you, risk adjustment is a liability, as an additional liability for insurance contract. But reinsurance risk adjustment can be thought of the ceded part of that risk adjustment. So what I'm trying to say is, let's just say an insurer has 1,000 in risk adjustment, and that reinsurer cedes like 500 of it to the cedes 50% of a risk to the reinsurer. So that again is essentially what would happen is the reinsurer would be getting 500, and the overall liability will be reduced by 500, because the insurer itself, the insurance company itself, will not be responsible for it. So it's like a debit account, or we can say it's an asset for the company, whereas risk adjustment insurance is a liability for a company. Now, with the reinsurance requirements done, we can move on to the disclosures. I'm just going to take a few more minutes. So IFRS 17 has obviously some disclosure requirements. Specifically, you can have like a profit and loss statement is there, statement of financial position is there, and disclosures, other extra disclosures that are mentioned here are there. So as I said, all these measurements, the actuarial measurements that I have just detailed, the level of aggregation, then the actuarial measurements, these will be carried out on these will be calculated and then represented in the profit and loss statement and the statement of financial position. The disclosures, they include reconciliation between the liability opening balances and closing balances. They have detailed elements of the profit and loss. They will have insurance finance income, transition balances, and significant judgments applied. So these are all additional details in the financial information that you present to the user of financial knowledge information, so that they can make more transparent based decisions. So disclosures are obviously these are the main disclosures that are required. And this is I would say as the structure of a typical IFRS 17 profit and loss and balance sheet. So you can see that in assets, you do not have like, I'm going to go for balance sheet first. You can see that there are no payables or receivables like that. You will have 2 heads, reinsurance contract assets, insurance contract assets, and liabilities, insurance contract liabilities, and reinsurance contract liabilities. A simplistic. Obviously, there will be other assets that are not shown here. So these are just insurance related assets, insurance and reinsurance. Of course, there will be cash, land, any machinery if it is there. So that will all be there. But these will be the insurance liabilities and assets that you will see. And on the other hand, you can see profits loss. You can see insurance service revenue, insurance service expense, and you get the insurance net income or expense from reinsurance contract. So you can see in a separate line, you can give a reinsurance separately, and then you get the insurance service results. Afterwards, you get the financial results. So this is also one of the areas where IFRS 17 is very clear. You can see that the insurance performance and financial performance is segregated into 2 areas. You can see that it is clearly split, but previously you were able to subsidize. You have a single profit and loss, and you can see that some contracts are not performing well, but the investment income obviously is there. So you will have like separately them separate out, and you can see what component is not working for you. So it might be higher insurance service expenses. It may be insurance service revenue, which is lower, or maybe it's the investment income which is causing the losses. So this is how it will be presented from the disclosure perspective. Other disclosures I have not detailed yet, because the main two are profit and loss and balance sheet that I have mentioned. All right, so now I will quickly turn to questions. If you have any, you can please post them in the meantime. Would you consider time value of money in PAA? Generally, if the contract is less than 1 year, IFRS 17 does not basically it allows you not to take the discounting. So discounting is not necessary, I would say. So what would we essentially what the idea is to use the most simple method, because that is easy to understand and explain as well. So although you can apply GMM to any contract, even if it is PA eligible, you can apply GMM. But companies usually go for a simplification. So maybe discounting would not be applied to PAA if it is less than 1 year. More than 1 year, yes, you can. Subsequent measurement, what will happen to the new generated contracts? Would they be added to the same group? Yes, it's a good question. Yes, the group of contract would be assigned only once. So let's just say if I have a contract, if I have a company, and in that I made a portfolio for term life, simple term products, and then I have onerous contracts, and then from that onerous contracts I have 2020. So term onerous 2020, all the contracts that I put in this bucket for the first time will remain in this bucket forever. Although it may become profit making, but we will not change the tagging. So tagging will only be done once. How will the CSM be released? Like, how would we know how much proportion to be released during the term of coverage? So this again is a very detailed IFRS topic. I encourage you to obviously read it out as well, but I'll just brief you. It is based on coverage unit. So you can Google it as well. But the idea is this: you base your release on the amount of service you have provided and the expected duration of the contract. To simplify things, I'm just going to continue with the term example. So the term example, I am providing insurance services only, and then a good proxy would be the sum assured. So that, because sum assured is the amount that I am I am standing by to pay to the policyholder, and then expected duration of the contract. Taking these two together in any mathematical way means you can multiply the two things, the expectation and the sum assured, or you can do anything. The IFRS 17 standard does not explicitly say that you have to do one or other thing, but this is how you will decide. You have to take into account two things: the quantity of benefit and the expected duration. So if the policy is 25 years, you will have to take that into account, that I cannot release 20% in the first year and remaining 80% in the 24 years. This would be incorrect, unless obviously your quantity of benefit provided is such. So that is, again, these are the two things that you can base your release of CSM to. Can you again explain how risk adjustment is a debit amount for reinsurance? So consider this in easier terms. Let's just say I'm going to explain it from the perspective of UPR. Now let's just say I have UPR for gross and then UPR for RI. So what I do is, let's just say if I received 1,000 premium and I paid 500 of it to the reinsurer, I will not hold the entire 1,000 in my balance sheet as liability. I will offset half of it because of the payment that I have made to the reinsurer. So similarly, risk adjustment is something that I am keeping as a liability for the unexpected portion. So unexpected portion, even in that, if something unexpected happens, let's say mortality tripled, like the pandemic hit. So the pandemic hit, obviously the insurance companies had to pay claims, but obviously they were reinsured as well. Again, the pandemic is a different situation, but let's say mortality quadrupled, God forbid, for some reason, then the insurance company will have to pay claims, but it will receive more claims for the reinsurer as well. The reinsurer will pay their share of the claims. So that is why we offset as an asset. So a risk adjustment is a liability from the gross or insurance issued side, and reinsurance side, it is an asset. So half of it, or whatever the cession percentage is removed. What if there are high interest rates? Yes, you're right. But what I'm going to say is that for 1 year, even in the case of, let's say, 20% interest rates, which is which I can say is a bit ridiculous. Obviously, you know that there are no 20% interest rate, but if you do it, it's like 83%. So even in case of 20% interest rate, so interest rates usually are not that high. In case there are very high interest rates, of course, as I said, the judgment does remain with the actuary, and he can go for a GMM application if seems fit. But obviously, there are a simplified approach is usually preferred, as obviously Albert Einstein said that a simple the model is, the better it is. Okay, I have what if I calculate the equals to at in accounting method? Nora, if you can please elaborate the question. If I calculate equals to at in the accounting method, I'm not sure I get that one. For excess of loss insurance, wouldn't risk adjustment be a credit? It wouldn't be a credit because think about the IFRS 17, what the definition of reinsurance risk adjustment is that it's not something that you are keeping for the sake of, let's just say, any uncertainty on the reinsurer's side, because that will already be in your fulfillment cash flows. But in excess of loss or any other reinsurance, if there is a risk adjustment, IFRS 17 says reinsurance risk adjustment is the portion of the gross risk adjustment that the insurer is sharing with the reinsurer. So if I just logically process that statement, I can already see that reinsurer is taking some of my risk adjustment, some of the uncertainty that I had with non-financial risks for the issued insurance contract. So let's just say I issued a life policy. There are some non-financial risks, and I have taken them up from the policyholder. Now I am passing them on to the reinsurer. That's why always the risk adjustment would be an asset from the reinsurer's perspective, from the reinsurance perspective. But you're right that there are risks associated with the reinsurer itself, and for that you put them in the, obviously, for example, there's a credit risk that the reinsurer will default. That is a risk, but you calculate it within the fulfillment cash flows of the reinsurance treaty, not the gross ones. Do we have to calculate and hold two separate CSMs for Takaful business? Operators fund CSM and risk fund CSM. Takaful is a very I would say it's a very debatable very debatable, what we can say is a concept here in IFRS 17 as well. What I will comment on is it's a debate is ongoing, and there are various iterations. Some say that for the policyholder fund, the shareholder fund, so one of the funds would have IFRS 17 implementation, the other is not significant insurance risk. These are the type of things. Of course, we are right now at a basic level. I'm not going to delve into the Takaful discussion right now, but it's as far as I said, it's a very highly debated topic in IFRS 17 literature as well. So if you are interested, you might as well maybe we can discuss it otherwise as well. But right now, since it would be a very off topic conversation, and in the interest of time, a very detailed one as well. So I'm sorry for that. I am just waiting for one. If Nora can explain me what the question meant. Otherwise, I can possibly handle it on to my colleague Annie, if there are no other questions.
Thank you very much, Muzammil. This was a very nice explained presentation. I think there is no any other questions, and if there is any other question, the participants is we're more than welcome to write it, and we can answer it later. We can now move to our next presenter, Qurratul Ain.
Hello, everyone. I will be presenting the comparison between IFRS 17 and IFRS 4. Given that we are running short on time, I will try to keep my presentation short and quick. It will be a reiteration of what has already been said by previous presenters. So just let me share my screen first. Let me know if you can see my screen.
Yes, قرة العين, your screen is visible and your voice is clear. You can go ahead.
But basically, this slide we will be comparing the liability, the measurement of liability under IFRS 4 and IFRS 17 for PNC business. This has already been discussed by Muzammil in his presentation, so I will just quickly go through it. In IFRS 4 for PNC, for liability for remaining coverage, as mentioned by Muzammil and Asad, we keep UPR, which is unearned premium reserve, less direct debit acquisition cost. For GMM model, as mentioned, this will be for IFRS 17. This will be CSM, fixed adjustment discounting, and fulfillment cash flow. However, for PA, it is, as mentioned by Muzammil, it is very similar to what we currently do. What is currently being booked by the company. It will be UPR as well as U minus stack amount. However, there will be a slight difference because like the definition of acquisition cost has changed in under IFRS 17. However, we will not really go into that detail because it will be a very detailed topic. But for under PA, the IFRS 4 liability for remaining coverage and IFRS 17 liability for the remaining coverage is very similar. As far as LIC is concerned, as mentioned, under IFRS 4, we keep outstanding amount and IBNR amount as well as ULE. This amount will be kept under IFRS 17 as well. However, there will be additional requirement as mentioned by Muzammil, risk adjustment and discounting. Under IFRS 4, the risk adjustment, as mentioned by Muzammil, has to be explicit. However, like currently, what certain companies do that in their claim liabilities, they put there are implicit provisions that has been inbuilt in their reserves. However, when we move on to IFRS 17, those implicit provision has to be explicitly translated to risk adjustment. So this is a difference, and one is the discounting part. Currently, especially in Saudi market, the IBNR part for LIC is not being discounted. So once we move on to IFRS 17, this has to be discounted for. One thing I also like to mention that for the LIC part, all the measurement model under IFRS 17, which is GMM, VFA, and LIC, they are all similar. If you can see that the only simplification is provided for IFRS under LRC. Let's move on to the next one. This is basically a comparison between financial statement under IFRS 4 and IFRS 17. As mentioned, if you can, in IFRS 4, if you look into this in IFRS 4, as mentioned, like investment, the total income, it includes the investment income. There is no distinction between finance income and insurance services. Secondly, the changes this change include your net changes. So there is no essentially difference. So you cannot really distinct between what is coming from the insurance components and what are the changes from your ceded components. And thirdly, the insurance this change is it's not very easy. You cannot very easily take what sort of information where the changes are coming from. Whereas if you move on to IFRS 17, you can see that insurance, as mentioned by Muzammil, the insurance service and the finance component, which is the investment income and insurance finance expenses, has been separated. Secondly, your net expense from the insurance contract, so your direct business, which is a gross business, and the result coming from your reinsurance business, they have also been separated. And all the changes that are coming from it will not be presented in your financial statement, but there are detailed disclosures provided. There are detailed disclosures that you have to provide under IFRS 17, in which whatever changes that is occurring from your incurred claims and your liabilities, they have to be detailed, so anyone can follow what other changes are coming from. So IFRS 17, everything has to be very, even though it's very extensive, but it's very transparent. So whatever changes in assumptions and everything, it has to be disclosed in the respective disclosures. This is a comparison between the balance sheet in IFRS 4 and IFRS 17. If you can, at the basic side of it, you can see that in the IFRS 17, for the liabilities and asset side, they have condensed it to reinsurance contract assets, insurance contract assets, insurance contract liabilities, and reinsurance contract liabilities. The balance sheet itself is very condensed. However, as I mentioned in the profit and loss account, they have associated detailed disclosures with it. So all the individual components for these will be disclosed in the relevant disclosures. So we are not going to go into the detail of the disclosure because we don't have enough time for that. However, let me just quickly go through the differences between IFRS 4 and IFRS 17. If you look into IFRS 4, the reinsurance contract assets, you will not find a counterpart for reinsurance contract liabilities. So under IFRS 4, the reinsurance contract assets and reinsurance contract liabilities are usually netted against each other and are shown in the single amount of reinsurance contract assets. The similar is the case with insurance contract liabilities. So if, for instance, consider a liability of reinsurance accrual reserve, in which is based on your commission. If it's based on performance commission, if the company, the liabilities is an income, so it's an asset. So, but it's an asset, but under IFRS 4, that asset will be netted with liabilities, which can be your outstanding claims and IBNR, and it will be shown as one item line. Whereas under IFRS 17, it will be shown separately. The deferred acquisition cost is shown separately under assets. However, in IFRS 17, it is shown under insurance contract liabilities or assets respectively. Similarly, for UPR, it is shown separately under IFRS 4. However, in IFRS 17, it will be shown under the relevant insurance assets and contract assets and contract liability account. This basically reiterates what I've already said in my previous slides, that the difference between the IFRS 4 and IFRS 17 financial statement components. Insurance contract assets and insurance contract liabilities, they are typically represented separately. However, since they are represented separately, there will be no change in IFRS 4. Insurance contract assets, as I've mentioned, they are typically netted with insurance contract liabilities. In IFRS 17, they will be separately. Provided deferred acquisition cost is provided separately in IFRS 4. In IFRS 17, it will be shown in insurance contract assets or liabilities and will be disclosed in the relevant notes. Similarly, for one more thing, that in IFRS 4, premium receivable and claim payables, they are provided separately. These are the separate items. However, under IFRS 17, these will also be clubbed into the insurance contract assets and insurance contract liabilities respectively. And the reinsurance parts of and the reinsurance receivable and the reinsurance payable will be clubbed into the insurance contract assets and insurance contract liabilities respectively. This is basically one of the example presentation of the P&L under IFRS 4 and IFRS 17 life insurance example. One thing I want you to look into is that let's just ignore, we won't go into the detail of the individual numbers, but one thing I want you to notice is that if you look in the total profit and loss for the year, if you notice that it is the same between under both IFRS 4 and IFRS 17. 67,073, and under IFRS 17, it's also 67,073, which is kind of understandable because your profit and loss is actually based on your actual numbers. So whatever your regime will be, the total amount, the total profit or loss that you will get will be the same under both regime. So for instance, but however, given that how you're reserving and your assumptions are changing, your year-to-year profits will differ. However, your total profit will be the same. One more thing, if you notice that under IFRS 17, the yearly profit is not fluctuating, is stable. However, under IFRS 4, the year-on-year profit, they are quite fluctuating. Even though the total is the same, but there's much fluctuation under IFRS 4 as compared to IFRS 17. One more thing, like if in year one, if here, like if you're making a profit, then if then in under IFRS 17, if on year one your profit is higher than in under IFRS 4, but since the total profit has to be same, then in subsequent year, your profits for under IFRS 17 will be lower than what it than under IFRS 4. This is a similar example, but it is for general insurance business. In general insurance business, the IFRS 4 presentation is slightly different. That's why we have presented it here as well. If you notice one more thing, here also, the total profit and loss is same. This will always be the case with every product, regardless whether whether we are applying BFA, PA, or GMM. The total profit under IFRS 4 and IFRS 17 will be the same. Now, since the presentations and how is very different for under IFRS 4 and IFRS 17, there can be an impact on how we assess our financials. Under IFRS 4, the top line of your financials P&L is gross written premium. However, under IFRS 17, it is replaced by insurance service revenue. Insurance service revenue, as shown as mentioned by Muzammil, is essentially your projected inflows and projected outflows. It contains what your expected claims are, what your expected benefits are, and if there are any loss component, if your account was loss making, then it contains that loss component as well. And if your account was profitable, it contains your release in CSM as well. So this is essentially quite different from your gross written premium amount, your premium amount. So this is not really comparable. So when you are going to do, whenever you're going, so eventually when you're going, when you are analyzing your financials, one should be wary of the changes that has been, that IFRS 17 brings. Secondly, the insurance service expense. This is the counterpart for your incurred claims, expenses, and expenses portion of IFRS 4. Apart from the internal changes, apart from the changes in how you derived it, how you arrive at the liabilities associated with the expenses, these two amounts you can compare it with your expense amount under IFRS 4 and your insurance service expense under IFRS 17. As mentioned, the net operating income, as we have already seen in previous slides, it depending on your changing in assumptions, it can vary very significantly under IFRS 17, especially for longer term contract. If, for example, if you are applying PA, in PA, since it's very similar to what we are, what companies currently do. So in that case, the net operating income, it's possible that the change will be not that significant. However, for long-term contract, especially VFA and GMM, for live business, it is quite possible that your net operating income for your will be very different. So it may not be possible to do a one-on-one comparison between years. If your first year, in your previous year, you have applied IFRS 4, and in recent year you have applied IFRS 17. So once you are doing your analysis, you should be very clear what changes has occurred. Similarly, for one thing I like to point out, that even though your changes, the presentation has changed and everything, but the company still has all the information that they used will still have all the information that they used under IFRS 4. So for their own benefits, they can maintain the PNL under IFRS 4 and do these and they can do the analysis, the analysis that you used to do previously. This slide basically we assess whether there will be any changes on the liquidity ratios, solvency ratios, on combined ratios, which are the three type of ratios that company essentially, these are the three KPIs that insurance and market essentially utilize to assess its financial position. Since liquidity ratio is based on your cash net of expenses, current assets and current liabilities, it is unlikely to have a change under IFRS 17 because cash and your current assets and current liabilities will change. However, there will be a little changes in all these at cash. So your liquidity ratios, it's unlikely to have a very this metric is likely to change under IFRS 17. Similarly, for solvency ratios, the solvency ratios, especially in Saudi market, it is calculated. It is as a rule based and the formula provided by the SHMA. So you provide the number and it's calculated by the prescribed formula by the regulator SHMA. So as long as these formula are not they will not be revised, how these solvency ratios are being calculated, they will remain the same. It is possible that there will be a difference in if it will remain the same. As far as combined ratio is concerned, combined ratio is mainly used in the general insurance market. It mainly includes your loss ratio, claim ratios, and your expense ratios. If your claim and expense ratios is greater than 100, then this means your product is loss making. This combined ratio, since the claim and the expenses part, the underlying component of the combined ratio is likely to change under IFRS 17. So the value of your combined ratio will change under IFRS 17. Secondly, these under IFRS 17, as mentioned by Muzammil in his presentation, now the company will need to be calculated CSM and profitability tagging. So these two new metrics, the company can utilize them in their when they are analyzing their financial statements. So basically, what CSM is, CSM basically reflects the profit that has still to be earned in the profit and loss for the particular group of contract. So this information can be used by analysts or investors who are interested in the year-on-year dividend stream, as there's a relationship between profit recognized and dividend stream. So if, for example, if the CSM is higher, then the investor will be more interested in those lines because it will in those companies, because it means that they will get higher dividends on that. Similarly, CSM can also be used to assess the performance of the new business, and it can be used to assess like whether the pricing and the setting of prices and the setting in pricing was adequate or not. The another requirement, the level of education requirement, in which under IFRS 17, the company has to check whether whether the portfolio is onerous, in which they have to demarcate the group of contract into onerous and non-onerous, can also help in highlighting the loss-making contracts. So it will help the company and the management in assessing which contracts are making losses, and whether they need to change its pricing, or whether they need to change its pricing or strategy, and if it is aligned with the within their appetite. It's high. So these are the new two metrics under IFRS 17 that in future the insurance market will use to analyze this financial performances. Moving on to, we will now discuss the improvement in IFRS 17. This is these all have been mentioned in previous slides in the previous presentation. So one of the can now see your participant can now see your screen. Okay. One of the main use of current estimates under IFRS 17. The IFRS 17 that the IFRS 17 requires the companies and the insurers to use the most current and up-to-date information available to estimate the stability, and they have to disclose those the assumptions that they have used in the disclosures. Whereas under IFRS 4, there was no such guidance, and the company does not have, and the insurance market and the companies did not have to disclose their assumptions. So it was the majority of the insurance did not really use the fully updated estimate, as they were not really required to disclose their assumptions as such in the financial statements. Now, as already mentioned by Muzammil, now the discount rates, there's IFRS 17 requires that a discount rate, they have prescribed the discount rate to be updated and to be reflected of the underlying insurance contract liability, rather than what currently under IFRS 4, what currently industries do, that they are very varying practices when it comes to discounting the liabilities. Certain companies, they use the expected returns of assets based backing the underlying liabilities. Some use risk-free discount rates. Some use the discount rate as prescribed by the regulators, and some don't really use any discount rates. However, under IFRS 17, the IFRS 17 has mentioned and prescribed a certain the characteristics that your discount rate must contain. So in this way, it has streamlined the use of discounting rates. Secondly, is all the third part is explicit risk adjustment. We have already touched upon this. So under IFRS 17, the risk adjustment has to be explicit, and it has to be disclosed, the method how you calculated it, and everything they have to be disclosed in the relevant disclosures. The risk adjustment has also to be linked to the risk appetite of the company. Whereas under IFRS 4, there was no such requirement of the explicit risk adjustment. So there were many varying practices under IFRS 4. However, under IFRS 17, this by mandating that risk assessment should be explicit, they have streamlined this and make it consistent across the companies. Okay, so this is the last slide. This is basically the improvement is consistent recognition of profit. As we have already mentioned, like under IFRS 17, the company are required to recognize the profit as per the contractual service, as per the release of their CSM and the risk adjustment. We are not going to go into detail of how to assign this, how to derive the recognition, how to derive the pattern for release for CSM, as it will be as it is a very detailed topic and it will require a presentation of its own. When under IFRS 4, there's no guidance as per say to under IFRS 4 to how to recognize the profits. So so there's as with other things, the companies, they have very varying practices. Some utilizes, some go with the regulators, but they have prescribed. Some companies use time basic, some recognize their profit at the end of the period, some expense it immediately. So this so what essentially IFRS 17 is doing is that it's making all the practices and all, making it very consistent across board, and is making it very transparent through disclosures. Grouping of initial recognition. This has been explained in detail by Muzammil at the level of aggregation in his during his presentation. So now, as mentioned by Muzammil, that IFRS 17 standard requires that the company, the grouping of contracts should be done at 3 levels: as portfolio, your issuance year, and your profitability. Whereas no such requirements, there was no such requirements under IFRS 4. Thirdly, on-risk contract visible in a timely manner. As mentioned, now, since you have to use profitability as one of your grouping criteria, all the contracts that are loss making are visible very in are visible in a very are visible very quickly. So and this was whereas in IFRS 4, if the company has the option to merge the loss making contract with the profitable one and marks and use the profitable one to utilize to absorb the losses that are being from the loss-making contracts. However, under IFRS 17, since you have to demarcate between your own risk contract and your non-risk contract, the company can know. So it basically highlights what your own risk contracts are and where you are making all the losses. This is it from my side. If anyone has any question, please let me know. Wait, let me just go. Hello.
Yeah, let's just wait. Maybe someone is writing anything. Let's give them a couple of minutes.
Will this session be released on any website or YouTube? Yes, I believe so. It will be released.
Yeah. We will upload it on YouTube in our club channel. So I think there is no any more questions, and if there is any question, you can write it in the chat.
If there are no more questions, then we can. Then I can hand over the presentation to Mohammed Saeed Zafar, who wants to end some.
Thank you very much, Qurrat Al-Ain. This was a very nice explained presentation. Also, our next presenter is Mohammed Saeed.
Thank you, Hassan. Just not exactly presenting. Just I'm gonna have some final remarks. Sorry, am I visible right now? Is that?
Yeah, Mohammed, you are visible and your voice is very clear.
All right, perfect. So just I think those of you who don't know, my name is Mohammed Saeed Zafar and I'm the managing director at SHMA Consulting. Very happy to be part of this virtual seminar, which is organized by King Fahd University. I hope the sessions have been informative for our audience and help the actual students at the university and I think those who are working to learn a few things. I understand. I think the topic is fairly technical, and I think it's possible that part of it might not have been digested by some of you, and I think that's okay, right? And I think just to give a background, because I think we have actuarial students here. I think it's important to understand that actuarial science. I mean, those who are especially students, and in particular IFRS 17, that's going to be key for the insurance industry, right? And actuaries are key to an insurance company, and they are involved in multiple key aspects related to it. For example, from product development to underwriting and pricing, reinsurance, reserving, solvency and capital management, ALM, financial reporting, and all the way to strategic planning. So now with this IFRS 17 getting implemented from 1st January 2023, and before that, of course, we're looking at a lot of work which needs to be done. Insurance companies are, they're going to be, they're probably not going to change the way they operate, but probably they change the way they report, right? So, I mean, that would probably have become obvious given the presentations by my colleagues, right? I mean, we can see the financial statements, whether it's income statement or balance sheet and disclosures, would be effectively presented in a different way under IFRS 17, right? So, and I think the interesting thing about IFRS 17 is it has a relation to everything that I said before. For example, you talk about product development or you talk about underwriting and pricing. There was discussion around level of aggregation. You talk about group of contracts, cohorts, profitability, and everything, right? So, I mean, I think those people who are involved with IFRS 17 and they are part of this learning experience, they'll get to get a flavor of that. They'll be involved with reserving because effectively the insurance contract assets and liabilities, I mean, the numbers for there will flow from reserving and so on, right? Reinsurance is now going to be looked at completely separately. So that is itself going to be key, and that would be something which would be I think currently, if you look at a lot of companies in the kingdom or in the region, they heavily reinsured, and you look at it on net basis. But now reinsurance will be looked at separately, and basically it's going to be important. So that is something which the standard itself covers as well. For life companies, ALM will be important, and I think of course the financial reporting that is going to change. I think I'm sure that was covered in length during this session as well. So I think there's a lot of change, and basically there's a lot of role for actuaries to play for in the future. If you look at the standard, naturally it requires it's talk about there's a lot of granularity, there's a lot of disclosures which are required, which basically means that you have to have data and technology which is to really be able to assess all that and basically to work around it, because effectively if you don't really have the data and then the technology, you cannot really do all the everything which is required as part of IFRS 17. In KSA, those of you who are working in insurance companies, SAMA has regularly issued regulation guidelines for the insurance industry. The insurance companies, most of them have gone through the 3 phases, which is the gap analysis, the financial impact assessment, and the design phase. And now, I mean, the companies are in the key phase, which is the implementation phase. Now implementation is effectively, it's basically the execution of what we saw, right? And that is where, I think those of you who are working or those who would be joining the insurance companies will effectively be actively involved. And I think for that, basically what's required is learning and training, right? So I hope that, this session has been helpful to you. It's allowed you to learn. But having said that, I think it's important to mention that this is a fairly extensive standard, and hopefully your learning will not stop here. Those of you who haven't really gone through the standard itself in that much detail, you probably go to the standard itself. There are illustrative examples, there's base of a conclusion documents, there's TRG meeting notes, and so on. So there's a lot out there which can be learned beyond this session as well. You can learn about the data and software management, because effectively when you be executing all this, you need to learn all that as well. So I'm sure if you get opportunities around that, you can rank on that, and you can sort of try to experience those as well. So finally, I think I'll just like to thank King Fahd University for providing this opportunity to us to present this, and hopefully we'll have more of such sessions. Thank you. Over to you.
Yeah, thank you very much, Muhammad. And it was our honor, and we are very glad to be a part of this seminar. This seminar was very informative and well explained from all the participants and the presented. The presented. We will upload the record of this seminar on YouTube in case if someone want to watch it again, or I want to make sure of information and double check. Muhammad, can you guys share the slides so we can share it in our groups, if it's possible?
Yeah, yes, I think we can share the slides.
Yeah, we will share it in our WhatsApp and Telegram group if anyone asked for it. So I think we can conclude our seminar. Thanks for the remaining participant, and thank you for your patience and share, and thank you for participating in this seminar. And also thank you, Shama, for this opportunity and involving the profession in the region. So thank you very much, and we can conclude. Thanks a lot.
Thank you, Hassan. Thank you everyone for attending.
Yeah, thank you all.